time beyond even what the market is anticipating. So even higher for even longer could be the scenario for the Fed if we do see sustained heightened energy prices.
Lindsay, it seems like everyone's thinking that we're in this soft landing type of scenario. It seems now a consensus among investors, among economists, at a time where you are seeing subtle shifts. You're seeing labor markets weaken. You're seeing people's pessimism about their finances start to really pick up. Do you start to see some of these signals as a sign that maybe we're shifting into something that's less, I don't know, auspicious, that's a little bit less benign than what people are portraying it as?
Well, it's interesting that the bar of expectation has been shifted so much lower that when we talk about a soft landing, it's simply maintaining the bare minimum of positive growth. Because right now, the U.S. economy is far from robust. It's still in positive territory, absolutely. But the momentum seems to be shifting, to your point, to the downside. We're a consumer-based economy, and while the consumer remains more resilient than we had anticipated, the momentum is clearly waning as consumers are relying on these temporary factors to supplement their spending. They're drawing down savings. They're pulling out 401k hardships. They're ramping up credit card debt. These factors are unsustainable. And so as we do expect these factors to be tapped out, that's going to provide more downward momentum for the consumer and by extension, then more downward momentum for the U.S. economy.
And this was a New York Fed survey yesterday that showed that consumers are finding it most difficult to access credit going back to 2013. Do you expect this to play out in retail sales that we get Thursday? Do you think that this is going to be on the table, or do you think that we're going to have to really wait to see whether or not this is truly going to affect growth?
Well, we have to be careful when we're focusing on one data point, the latest data point, particularly when it comes to retail sales, as we have seen a tremendous amount of volatility as consumers dramatically shift the goods and services in their basket on a month-to-month basis. But when we talk about that, that's a broader implication of the consumer recognizing the fragility of their household balance sheet, something that we do when we're increasingly concerned about our financial footing. So it's not necessarily about one data point, but that downward trend of momentum. And keep in mind that consumers have been pulling away, not just in terms of the nominal dollar spent, but shifting away from goods or stuff, increasingly back to that pre-pandemic trend of relying on experiences or services for the vast majority of their monthly expenditures.
One of the experiences, Lindsay's watching Bloomberg surveillance. It's directly folded into GDP. Lindsay, I did an analysis yesterday before the pandemic of Europe up a total of 8% nominal GDP, while America exploded up 24% nominal GDP. 12 months forward, what is that combination of real GDP and inflation? What's the nominal run rate going to be out well into 2024?
Well, let's start with the real rate. I think the real rate is sub 2%. I think the longer term trend for the U.S. economy is about 1.8. You layer on 2-3% inflation in an optimistic world, and we're closer to that 4% range for nominal GDP.
So let's finish where we began, Lindsay, where Tom was asking about oil prices and how that could really change the Fed's trajectory and change the inflation picture. Is there a price of oil where it becomes inhibitory for the consumer, where suddenly it does impede on their discretionary spending in a more material way? Are we getting close to that?
Yes, I think we are. I think right now, as we just talked about, the consumer is on increasingly fragile footing. And again, we use this word resilient for the consumer, but that's in context of what we had anticipated, a more precipitous decline in activity given 500 basis points plus in terms of Fed tightening. But the fastest way to derail the American consumer is sustained heightened energy prices. And we've seen this play out in cycles before. And so if we start to push towards $4 a gallon or over $4 a gallon, that's going to be very difficult for the average household balance sheet to absorb, particularly when we have other costs coming online, particularly student debt payments. When the average household has a difficulty footing a $500 shock on a monthly basis, any type of tweak to pulling away that discretionary spending, be that to filling up the family car or paying down those monthly debts, this is going to have a significant impact on the consumer's ability to spend out in the marketplace and continue to prop up the U.S. economy.
It makes you wonder how many expensive smartphones they'll be buying, Lindsay, this quarter, doesn't it?
It does, absolutely. But remember, that has become less of a discretionary purchase and more of a necessity as of late.
The iPhone 15, TK, necessity. Is that what you're hearing at home?
My variable on this, I've said this, Dan Ives I thought was great on it, huge disagreement on this, is are the phone companies going to help us with our necessity
Yes.
payment? Really, to me, that's the heart of the matter.
Hey, Lindsay, thank you. Lindsay Perks are there of Stifel on the latest. Let's get to a survey from Bank of America, their fund manager survey on policy. 6 out of 10 say the Fed is done. Back in July, 9 out of 10 said the Fed is not done. What a difference a couple of months makes, Tom. Just a total mood swing off the back of the CPI data over the last few months.
It's data dependent, and really over the next 12, 15 days, we're going to be as data dependent as ever. I don't have a clue where we're going to be. You can guesstimate it. You can bet on the market about it. What I would suggest off of this weekend is there's a fair amount of gloom out there. I mean, I think, gloom is... I can't say gloom is back in place, but there's enough narratives of gloom.
Based on the tease I'm about to read.
Yeah.
This is a new one. When was the last time we did this? When was the last time we did this? We're going to be catching up with Dr. Hansati, Johns Hopkins, on the new COVID vaccine.
I called Qantas up and I said, get Hansati on, because I'm going to get the booster. And I need Dr. Hansati, I'm
okay, so let's do this. You have an honest and open conversation about whether you should get that.
Yeah.
That's what you should
That's
do.
why we're doing this.
Okay, great. So this is like your doctor's visit live on.
Yeah, it is. It's live
TV
on air.
radio.
Johns Hopkins. They're the best. I mean, their websites are great. Their rheumatology is world class. I mean, scary, scary good stuff.
Okay. That conversation just around the corner.
Yeah.
TK with a doctor's visit. We should brand that, Tom.
Yeah, we're going to do a
got special
social media
graphics.
thing on it.
Okay,
Seriously.
great. All right, cool. All right,
Not
look
now,
forward to
but
that.
when I get the shot.
Well, no, we're going to do that next too. We're going to have the conversation.
I've got my comfort dog goes with me. I hold that bill.
You take a comfort dog. Is
Yeah,
is that actually a comfort pet? A therapy dog?
Yeah.
Okay.
Yeah, he's
You
coming
take
to
that on
London.
planes with you?
He's coming to London.
Nice.
Yeah,
Did you buy a seat especially for him?
Just for him. Thank
Beautiful.
you, Redo.
That's sweet.
Keeper of the MX.
And you expense it too.
Sure.
That's good to hear. From New York City this morning, good morning to you all. Equity futures down here by a couple of tenths of 1%. Your iPhone 15 unveiling a little bit later this afternoon.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
To the kabaddi tournaments in India.
to the cornhole boards at your local tailgate. This is what's next in sports.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The labor market is so important because it really supports the consumer spending, and we've seen the labor market cooling off. We should eventually see signs of consumer spending cooling off. There's been downward pressure on inflation, but it's a really tricky needle to thread in terms of doing just enough, but not too much.
So difficult. Claudia Sam there of Sam Consulting, the founder and former Fed economist. Looking forward, Tom. You could take that clip, play it all the way through the year. We've just heard it a million times. This is what's going to happen. This is what's going to happen. And it's happening way more slowly, far more slowly than we anticipated.
It's sort of Humility Tuesday. This came from James Dimon talking about he wants primal scream for humility on bank capital requirements. And there's other issues this morning on humility. And Claudia Sam's economics is an economics of humility, where she will make statements, but she hedges every step of the way, particularly on recession.
She's fantastic. Just one of the best at that. Looking ahead to jobless claims on Thursday, retail sales on Thursday as well. Tomorrow morning, we'll get CPI in America. Going into all of that, equity futures just a little bit softer here, negative by 0.2%. No real drama here on a 10-year, 427.82. I want to go back to that quote from Marko Klanovic over at JP Morgan. The risk, the potential for a commodity price surge to feed inflation and extend central banks hiking cycles. That's the call from the man at JP Morgan in the investment bank, Tom, at the moment.
Well, we're going to have to see how that goes. I mean, there's going to be a lot of, but the opinions are going to adjust here by Thursday or by Friday. I mean, Kalanovic is probably going to publish 3 times.
Well, it depends on where crude is, but yeah, I mean, he's been pretty bearish on stocks through much of this year.
This is a joy to do this in remembrance of how people stepped up big time in early 2020. I have a clearest memory of our first interview on COVID. It was with an acclaimed radiologist from Mount Sinai in New York who brought into our studios x-rays from China showing the outside lung damage that COVID could wrought. Johns Hopkins helped us so much on this. And joining us now in the booster uproar, Bhakti Hansadi, to say she's Associate Professor of Emergency Medicine, barely describes the global parchments, the study, the academics of Professor Hansadi. Bhakti, great to see you again under always COVID difficulties, to say the least. When we were kids, it was routine to get a booster shot. Is an mRNA booster shot any different, any more dangerous, any more at risk than a tetanus booster shot of my childhood?
Absolutely not. The current new vaccines are not technically boosters, or updated vaccines that are targeted to the current viruses that are circulating, but they're equally safe. These vaccines have full approval, i.e. they've gone through all the scientific rigmarole to ensure that they're safe and effective for the population.
Bhakti, I look at the science here, and it seems in order. I'm basically appalled at the government response, the messaging from the White House to get behind the science community. What do you need from the president? What do you need from the administration to build confidence in this booster program?
So I think we clear messaging. This is full approval, number 1. 2, we need to hear from the CDC today. They will be deciding who should get the booster, who do they recommend, but also the reasons for those recommendations. Why is that the current recommendation? And what are they trying to do by making this recommendation? Are they trying to prioritize those at highest risk? Or are they genuinely saying that the vaccine is only recommended for those people it will benefit? So we need clear communication, clear logistical reasons as to their recommendations. And the third is we need to make sure our supply chains are strong. So we need to make sure this vaccine comes out later on this week, that folks know where to go, that folks can access the vaccine quickly and effectively.
How much did the administration and policymakers really set themselves back by trying to clamp down on the message so hard initially? There was just a court ruling saying that the administration did overreach in trying to strip away any anti-vaccine messaging. How do you view that in light of what you're trying to put forward right now?
So we view that because it has this paternalistic attitude to health, right? But we are all informed partakers of our own lives, our own health. We have access to information, some good, some bad, some here, some elsewhere. And so by having communication that is more robust, that's less black and white, that allows for effective dialogue, that allows individuals to buy into the whole, the interventions, the vaccines, the therapeutics, the masking. And so what we need is to ensure that there's dialogue, that there is debate, that debate is has a scientific foundation.
There's also been a lot of discussion about side effects for the vaccines, in addition to how much they actually prevent you from getting more sick. If you're going to still get sick and you've already had it and you're not going to die, you know, there's this sort of feeling, what's the point of increasing the potential risk if on the downside you could just spend another day in bed? What's your view on that?
Absolutely. So first of all, the FDA would not approve a vaccine where the likelihood of you being sick is greater than the illness itself, right? That is just not going to happen. So the side effects of the vaccine do exist, but they're over-reported, partly due to the media. We over-report rare events that can be dangerous. As far as the illness from COVID-19, it affects different people differently. So if you have multiple comorbidities, you have existing lung conditions, you may in fact require hospitalization. Hospitalizations went up by 8.7%. So it's not as if this disease is a benign common cold where you're just going to spend an extra day in bed. I had the pleasure of treating several patients over the weekend at Johns Hopkins Hospital Emergency Department, and the majority of my patients went home, but some patients did require admission. A lot of patients reported that they were fatigued, exhausted, couldn't go to work, couldn't manage their activities of daily living, couldn't look after their dependents. So if you're responsible for a family, for children, elderly parents, or you need to go to work, then get vaccinated. The chance of you doing that is much greater.
How is this different from the flu?
Not significantly. The flu has the same constellation of symptoms: fevers, chills, colds, congestion. COVID will present the same, as will RSV. And that is the challenge here. COVID illness will likely be underreported because some people may assume that they just have the flu. And that's okay as long as you're staying at home and isolating.
Dr. Ansari, what is the science of masks? I don't want the politics. I don't want the mumbo jumbo. I can't stand them, full disclosure. But what is the science of masks in this COVID of 2024?
The science of masks is when masks are worn, they are effective at preventing onward transmission. A lot of the literature that you're seeing right now misinterprets the data and how the data was collected. A lot of the data is in non-COVID eras, in individuals who are not accustomed to wearing masks. But the data from COVID during masking in healthcare facilities showed that there was very little healthcare worker to healthcare transmission when healthcare workers were wearing masks, even if they were COVID positive at the time. So the science shows that masking works. I also hate masks. My patients feel better when they see my face, they see my smile. I'm able to reassure them during their illness. So I currently am choosing who I mask and who I don't mask with. If someone does not have upper respiratory illness or flu-like symptoms or is not immunocompromised, I'm currently, right now, this is today, I'm not masking. In the future, I may change that if COVID-19 cases continue to increase.
We want to see you smiling without a mask. Doctor, thank you. Dr. Bhakti Ansari there on the latest. TK, it's been a while. I love seeing the doctor. Let's hope we don't have to do this too often going into winter.
I just want to
don't think anyone wants that.
Yeah, I just do science here, and I just want the politicians to be forthright about it. I get that there's a political debate, and there's an advantageous outcome for politicians to politicize science. That's always been the case.
After all these years, why are we still talking about science as if it's definitive and not a process of ongoing study?
It's not definitive. I sat in classrooms in microbiology when mRNA was a pipe dream of David Baltimore and others on the island of Manhattan, Baylor in Texas, mental block. Anyways, there were people with David Baltimore 50 years ago doing this in mRNA, and now it's saving our lives and saving some lives at risk.
The problem is there's nuance. There's data that's better than others. It's very difficult to know. And how do you come up with a public policy at the same time of trying to follow the nuance of science? Did they do it perfectly? There's a lot of criticism. So how do you then form a policy now with public trust that has been impeded in a significant way in certain corners? And it's going to be a real challenge going forward.
Oh, public trust has been shattered. Absolutely
yes, that is accurate. That is accurate.
Big time.
And I would say, am I right, John, less in England where you've got a huge microbiological, Imperial College and all that, you got a real belief in it.
You were lied to on so many fronts, Tom, not just misled. Flat out lied.
Shattered is absolutely the right word.
Stuart Kaiser of Citi is going to join us shortly. We'll talk about markets, less about COVID. Equity futures on the S&P negative here by 0.2% from New York City this morning. Good morning to you all.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Central banks around the world, both developed and emerging, are fighting inflation.
I really think it's about ECB policy, how that relates to Fed policy and this U.S. dollar.
The consumer remains strong, so there kind of continues the challenge that the Fed has.
The last mile is going to be hard, but I do believe that we are very much on that disinflationary trend.
I think we're in this very hold your breath kind of moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
In many ways, the week begins today. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market's slightly negative by 0.2% on the S&P 500. Tomorrow, the big data point, CPI, just around the corner tomorrow morning, stateside. Before we get there, later on this afternoon, a much-anticipated iPhone 15 launch, Tom, after a week of weakness from that Apple stock.
Can we try to get Apple tied into the CPI report?
Can if you want, yeah.
UAW strike? I don't think we can.
Higher prices.
There it is. There it is. We're going to see it this afternoon. We've got our full Bloomberg technology team.
Ed Ludlow, Caroline Hyde.
Styling, they're there.
Bases loaded, TK.
It's going to be there. I think they're doing a new iWatch, not getting much traction. AirPods better get traction.
Another set.
Well, we've got an odd set under the couch, so we got to replenish, I think is what
with a new set.
Sets.
Sets.
Yeah,
plural.
you have to have them.
Okay.
I've never owned them, but Others, they
You don't
walk
have a
around
set.
the house.
You don't
I
use
don't
them.
know. I don't
Okay,
use them.
you're still doing like old school.
They walk around the house. Afterthought has a set, and
Is that
Mrs. Keena has a set.
Is that the family dancing? Is
the
that
vet,
what that
yeah, the vet.
body
This
action
is
is?
vet.
I've got no idea what your body's doing right now.
This is vet walking
Is
around
that
Central
what
Park.
you consider dancing
Yeah,
to be?
vet Bill's walking around Central Park.
Your
with
body's
his
just sort of
earbuds in.
like pulsing. It's
Yeah,
quite distracting. Okay.
I'm getting ready for the music of the
Let's
Apple
talk about the serious element to this story, the serious side of it. There's some new competition in China, Huawei, 1, and 2. There's the government pushing back, TK, pushing back and banning the use of iPhones across certain agencies, certain state employees, and maybe even state firms based on our recent reporting.
Lisa mentioned it earlier. We report today that they're looking at an India phone to be ready day one. I did not expect that. There it is. So, did they mention the politics today? I don't think so.
No, they're trying to avoid it, but Lisa, the foreign policy of this story is absolutely fascinating for so many people, particularly after the events of the last week or so.
Yeah, considering that about, a fifth of the revenue comes from China? I mean, is this an insignificant? Whether Tim Cook weighs in, probably unlikely. At the same time, whether he signals something with India, I think that that's a signal people are getting.
Do we get a higher average selling price off the back of a phone that doesn't really have many big improvements?
You've mentioned this. If they get sort of subsidized by pay-as-you-go, can you see that kind of price going up? It depends on what they offer. I mean, this is an increasing staple. So at what point do you push people out of the market or basically say you're not going to resurrect your previous phone?
I take immense issue with this push people out of the market. They have done this perfectly. They got monthly plans. Your phone service can give you a monthly plan. Who pays $1,100 for one of these toys?
It's a monthly payment,
Nobody.
sure, but it's still a big monthly payment.
I'll go with that. Okay, it's a mortgage payment, a car payment, whatever. But the fact is, this idea of the Apple gloom crew that, OMG, it's $1,100, we're all going to die. There's no evidence that's slowed sales.
I don't know. At a certain point, you could say that $1,200, $1,300. Okay, everyone, great. No, oh my God. Well, people are going to get concerned at $4 a gas for a gallon, and you're at $3.83. You're not that far away. So at a certain point, people are like, "We got a phone. It's fine. It works. Fantastic."
They're going to look at $134 at T-Mobile, Verizon, AT&T. Let's go. Can I get it in red?
Maybe, yeah. Look, I would say this about these big tech firms in their current form, and I've asked this question a few times. When was the last time they had a real cyclical test? And think it through. The last decade. When was the last time they had a real cyclical test in the last decade?
Well, they had
I don't
one
count the
2
pandemic.
decades ago, but
everyone got sent a check, and a lot of people went and bought an iPhone.
Yep.
Based on the
There's
sales.
no question about it. It's been a hell of a
I'm not sure
ride.
they've had one.
No,
they're getting one right now in China
agree with that.
potentially
It's
on
been a hell
several
of a
fronts,
ride.
and we'll see how it develops stateside. Equity futures on the S&P look like this. We're negative by 0.2%, pulling back just a touch. Yields unchanged. 10-year 428. Crude. Take a look at that. $88 a barrel on WTI, and in the 90s on Brent crude. Lisa, this morning 91.28.
And we're expecting any minute a further kind of upgrade on the outlook from OPEC. They're putting out their monthly report. Very curious to see how the Saudi Arabia cuts to production in Russia as well is affecting that outlook. 1 p.m. is the launch of the Apple's iPhone 15. Very curious to hear what they have to say about India. And today we do get some words from David Solomon of Goldman Sachs at the Barclays Financial Services Conference in New York. There also are a number of other speakers as well from Wells Fargo, Barclays, Deutsche Bank. I want to hear if they talk about consumer credit and what kind of spending we could see going forward, John.
Stuart Kaiser joins us around the table, head of US equity trading strategy over at Citi. Good morning, Stuart.
Good morning.
Let's talk about inflation tomorrow morning. Am I trading headline CPI or am I trading core?
Core, I think.
Core?
Yeah, core inflation. I think anything that rounds down to a 0.2, the market will take pretty well. If it rounds up to 0.3, which is kind of where our economists are, then, it'd be a little bit of test for the market. But yeah, it's core inflation. And then obviously drilling down to this, non-shelter, core services bit as a secondary look.
Any reason to be excited about share pound next week, given what you just said?
Yeah, I mean, look, they're going to update the economic projections. So I think that's probably going to be the most interesting. What do they do to the growth forecast? They're probably not going to move the terminal rate, but if they were to play around with that would be a big focus. So I don't know that the press conference itself, but I think looking at the economic projections will give you a good idea into how they're thinking about the world.
Kaiser speak is we're fading inflation and we're chasing growth. That's the jargon that someone like you uses. What's the bet on the market now? Have we gotten gloomy across a gloomy August?
I mean, we pulled back a bit in August. I think rates rose for not good reasons, which was a bit of a change from earlier
What's
in the
the
year.
bet of hedge funds and all the other fancy people? Is there a big bet? OMG, we're all going to die.
Hopefully there's not a we're going to die bet. Look, our core view is modestly positive. I think people are probably generally in that camp at this point. But, valuation's gotten to a level and the performance has gotten to a point where the risk reward just doesn't look great. So I think if people are in the market now, it's with a fair bit of caution. And I think the reaction function of investors is to get out quick if the data starts to deteriorate.
Was Tesla's 10% rally yesterday caution?
Caution? Look, Tesla has these rallies, now and again. So I'm not too concerned about it, I guess. We've had a few of these moments, I think, in the last month or so where the market's moved quite a bit, and it's a very concentrated move, whether it's like high short interest stocks or Tesla or a pocket of the market. And, I think that really just speaks to the fact that people are a little bit on edge, and there's just not a lot of tolerance right now. It's ask questions later type market if the news comes in good or bad, and I think that's what you saw with Tesla probably yesterday.
I want to get a sense of where you stand on the bull case and the bear case. Greg Battle is on and saying basically a hard landing would be the bear case, and something of a reacceleration would be the bull case. Do you agree, or do you think that there is this sort of perverse reality where if things reaccelerate, that could be the most negative outcome for equities?
Not my view. My view would be good data still good. Jonathan and I were joking about this last week. They call it bad data because it's bad. They call it good data because it's good. This is a nominal growth asset. So I think if you're rooting for growth to slow down, you're probably rooting for the wrong thing, in my opinion. But yeah, so to us, it's a soft landing, reacceleration in growth, I think, is the positive side of this thing. The strength in the economy this year on a relative basis has been the labor market and services spend. So I think that's the part of the market that if it started to weaken, that's where you want to really be careful. We're not of the view that you buy the first sign of weakness in the labor market. I think if you start to see those payrolls come off, you want to be very, very cautious and kind of step back and let that happen. Again, because this is a growth asset, and we're not in the camp of rooting for bad news at this point.
Stuart killed me last week. The team did this big preamble, highly produced segment about bad news, good news, bad news. Stuart just came out, TK, and said, what are you talking about? Good news is good news, bad news is bad news. Stuart, what's interesting, though, this year, we've had a year of upside surprises in the US economy. We also touched on this, and we've had a growth rally off the back of it. Now, can you make sense of that? That's not what's meant to happen, is it? If you get better economic data, shouldn't I see the rally elsewhere?
Yeah, I would agree with you on that side. I think what happened coming into the year was that growth part of the market was very, very under-owned. Expectations were low. The valuation had gotten washed out in 2022. So you had kind of a perfect storm for a positive growth surprise, pushing people into that space. I think the other part, though, is even though growth has surprised, there is still, generally speaking, a scarcity of earnings growth in the world. And it's those large cap tech stocks in the U.S. that are producing that earnings growth and are producing those positive consensus revisions. So our view is that's really why they've performed so well. It was evaluation washed out, sentiment and positioning was quite low, and then you got strong consensus revisions helped by AI, and that's why we think that part of the market worked in a positive growth environment.
Whatever your belief is, go back on Bloomberg Digital today and all that Lisa does in the newsletter, and re-listen to Stuart Kaiser. Let's go back and re-listen to Stuart Kaiser. You nailed it. The pro tip is nominal is the way to think about this, and it is a nominal growth asset. And the answer is if we're still popping 4% nominal GDP, the OMG we're all going to die crew doesn't get it done, do they?
Yeah, look, I think that's where, especially from the earnings side of things, that people got things a little bit wrong. There was a view that earnings were just going to get massacred because the Fed was hiking rates. But when you're putting up, high single digits or low double digits nominal growth, it's hard to get it lower.
Is a simplistic statement. The Fed works in a real rate environment, and Stuart Kaiser works in a nominal rate environment, right?
At least for this year. I said at least for this year. But no, that's kind of our view on equities this year. Is if you were expecting a significant deterioration in earnings, that was very hard to accomplish in a positive nominal growth environment. And I think people kind of got surprised a bit there. The real test maybe next year is as nominal growth starts to slow, what does that do? What does that do to margins, particularly in the equity market? And we'll have to see. That's probably 6 months out, and we've got a lot of hurdles to jump before we get there. But that'll probably be a big discussion for 2024.
When do you start looking at oil prices as a potential headwind?
It's a great question because the oil trade and the China trade, frankly, this year, I think people have multiple times this year tried to take upside shots at that trade, and have largely been disappointed. Now, finally, we get the oil breakout, and nobody's talking about it. So it's a very sort of perverse dynamic there. But look, I think at these levels, if you can sustain these levels, you start to worry a bit. To your point, gas prices are getting near $4 a gallon. That'll start to flow through to headline CPI, and people will start to pay attention to that. So I think at these kind of levels, you're paying paying attention to it. I think there's probably a view out there that OPEC is trying to keep oil in, call it a $70 to $100 range or something like that on a go-forward basis. And as much as $100 oil hurts, I think if the market becomes convinced that oil is sort of range-bound, that's something you can invest around. You can sort of trade that range. You can forecast that, and it is positive. So, look, at this level, you do start to worry about the impact on consumer spend and headline. But, I think if we got to triple-digit oil, that's when you're really worried about what is this going to do to the market.
Not far away, $9 right now. The crude bulls were right in the end for different reasons, I guess. We all thought Tom crude might be up here off the back of China reopening. I'm not sure that we had crude in the 90s with China disappointing on growth. That's where a surprise has been.
The key thing is you can be right for the wrong reasons, and
no one cares about that.
I got a line of trophies where
it's always harder, I think, when you get the macro call right and the market call wrong. Stuart, thanks for being with us.
Thank you.
Stuart Kaiser of Citi, thank you. If you are just tuning in, welcome to the program. Equity futures here negative by 0.2%. Coming up a little bit later, Bob Michael of JP Morgan Asset Management. We'll speak to him in about 48 minutes. He is bullish on bonds. He's not alone. Matt Hornback, Morgan Stanley, says 350 on a 10-year. Mike Schumacher, Wells Fargo, says 350 on a 10-year. BMO's Ian Lingen sat in Stuart's chair about a week ago, and he said the 10-year was a screaming buy. We'll talk to Bob about that.
Down. He didn't
Something like that,
yeah.
You want to talk Aaron Rodgers, Stu? Do you want to fit in a bit of football? Bills Jets. What was that about?
If you're a Jets fan, did not expect this to happen, then you haven't been a Jets fan for long. I mean, this was the most well-telegraphed disappointment in the history of sports.
And then you won anyway.
That's you know what that means? People are going to have hope for another week and just get disappointed again. But I've been a Jets fan for a long time. This is exactly.
So what's the trade? Fade the Jets.
Yeah, the good news from this is we get to keep our first-round pick. So you have to really focus on the narrow silver lining if you can nestle yourself in there.
Lisa, you mentioned this. He's out for the season. That's presumed.
We don't know.
Potentially.
We have no idea. We are going to find out from the scan.
Where's Mohammed? Mohammed would know. Probably Mohammed talked to Aaron last night.
Lisa, we know he's out for the season.
Oh, is that that's
the problem in football is the season's so short. If you pick up an injury like this, you're not coming back.
Yes.
You're not coming back. You've got like 4 months to try and recover.
Terrible.
To try and turn it around. Stuart, good to see you.
Good to see you too. Thanks for the uplifting sports conversation.
Fantastic. Anytime. Well, you won. That's the punchline. AMH is joining us from Washington in just a moment. Bloomberg's chief Washington correspondent. Big conversations to be had down in D.C. Impeachment. I need to talk about the potential for impeachment. Unbelievable. From New York City, this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think it is important to be able to have a dialogue with China and with their leaders. And I think if we can continue to have that dialogue, that's probably the best approach to take right now. Maybe we can make some gains in trade and in some other areas like cyber, and at the same time, obviously, maintain our differences with regards to our military positions, particularly on Taiwan.
Effectively endorsing the position of the president over the weekend. That was the former U.S. Secretary of Defense, Leon Panetta, speaking on Bloomberg's Balance of Power in the past 24 hours. From New York City, welcome to the program. Pushing ahead to the iPhone 15 release a little bit later on this afternoon, then on to this morning. Rather tomorrow morning, CPI just around the corner. This morning, equities shaping up as follows on the S&P. We're negative by 0.2%, just a slight pullback, a little softer. Yields going absolutely nowhere. Your 10-year 428. Drew Mattis and Manulife just writing in. Drew Mattis is looking for 4% year-end on a 10-year, 350 by next year. So 350 is this number, Tom, getting banded around here, there, and everywhere.
That's a working yield, and we mentioned Ian Lincoln with the drama of a screaming buy and all that, but there's a fair amount of debate about this. I mean, it's a range thing, and somebody's going to lose some money on this. I don't know who, but there's as big a debate in the bond market as there is in the equity market.
Well, what's been amazing, even with the likes of MetLife's Drew Mattis talking up 4% year-end, 350 next year, Tom, we're still in and around 5% on a 2-year, still in and around 430. Yeah. On a 10-year, just sort of stubbornly maintaining these levels, even though many people have said they're not sustainable.
Well, that's the point. People say they're not sustainable, except they were for decades.
Are we back to the old normal?
In the old days, this was normal, and is a 7-8% mortgage normal? I don't think so. You got a real rate on real estate that doesn't work. But the answer is, this is sort of what it used to be like.
7% mortgages still aren't normal. That's just the price right now.
There was decades
Torsten Slok of Apollo putting this one out over the weekend, Tom. The share of mortgages outstanding by interest rate at origination.
Yeah.
So this is dated data. It's from early this year, but I think it still holds. Below 3%, that's 23% of the market right now, Tom. 3 to 4%, 38%. 4 to 5 is 20. 5 to 6 is 10. Above 6%, only 9% of outstanding mortgages at origination. So the price we're told at the moment, Tom, is around 7, but ultimately, hardly anyone's paying it. They're locked in for a whole lot longer.
Does policy clear this oddity? I don't know.
I'm not sure how it does.
Yeah, I don't know. Because it's not, to be clear, folks, in Europe and particularly in the United Kingdom, you don't have this.
No, different structure.
Because of floating rates.
Different structure. And the fixed rate agreements aren't this long. You wouldn't have a 30-year locked in this way.
A couple years ago, there was a 280-page jewel by the always brilliant Cass Sunstein. It was called Impeachment. And for all of us, including me, that think we know impeachment, but we don't know impeachment, the answer is Cass Sunstein wrote a primer back before Andrew Johnson and the ballet of the 1860s. Amory Horton joins us now on the 2024 impeachment debate of Washington. Emery, this isn't in Cass Sunstein's book. The Senate and the House, the polarity has to be historically unique, is it?
Well, they're very polarized at the moment, not just Democrats and Republicans, but the House and the Senate in regards to a number of issues. Impeachment inquiry looks to be one of them, as well as also comes to funding the government. If you look at how the House wants to have their appropriation bills tallied, and the Senate, which has had 12 appropriation bills come out of committee, and then we'll be seeing them hit the floor, we're looking at a $100 billion difference. It's going to be very difficult if the House and the Senate are both able to even pass those 12 appropriation bills. The Senate looks like it's moving in a more bipartisan fashion, though, and then it goes to a conference. It's going to be very difficult to see how they're going to end on the same page. The Senate actually wants to spend more than what was agreed upon in the debt ceiling deal struck between Speaker McCarthy and the administration, while the House is looking to extract more in terms of what they're calling fiscal responsibility and trying to cut even more off that deal.
Civics 101 with AMH. Let's do it right now. What this is about is linking a potential shutdown to a potential impeachment, I'm going to call it discussion or debate. How do those two conflate together?
Well, there's this potential impeachment inquiry, which we heard Speaker McCarthy talk about a number of times. He's really being pushed by the far hard right flank of his party. And Punchbowl News this morning, run by Jake Sherman, is saying that this week he's going to discuss this behind closed doors. So he's ready to move and give his promise that there will be an impeachment inquiry into President Biden's son, Hunter Biden, as well as the president himself. Obviously, that would be the impeachment inquiry, Joe Biden. And Speaker McCarthy is going to say that this means the House Judiciary, the House Oversight can continue the work of Jim Jordan, James Comer, in getting the Biden family's bank records. The issue, of course, is, does he have the votes to do this? There's a lot of Republicans in moderate districts that vote for President Biden, that do not want to take this vote, even though the Speaker and a lot of individuals in the Republican Party say this is just an inquiry. But what Speaker McCarthy may be doing is holding and dangling out this impeachment inquiry to get the hard right, the ones that potentially want to see a government shutdown because they're not happy with the level of fiscal spending, to go along and vote for continuing resolution to keep the government open after September 30th. It's a bit of a carrot and stick approach.
The fact that this sort of Hail Mary approach is being floated right now, does that indicate that the chance of a government shutdown is looking more likely?
Well, it depends. If he's successful in this, potentially he will get those votes for a continuing resolution. Also, a continuing resolution could garner a lot of Democratic votes. But does he now isolate those Dem votes if he goes for impeachment inquiry? It's really difficult right now for Speaker McCarthy. I feel like I've said this a lot of times on this program, but this does feel like this is going to be one of the hardest mazes for him to navigate. I think one representative yesterday, Mr. Womack of Arkansas, put it very well. You have an individual, any individual in Congress is saying, I will only vote for this bill or this priority if XYZ demand is met. So you have about 15 Republicans who say they're not going to vote to fund Homeland Security if maybe Secretary Mayorkas is not impeached along with it. So these are the kind of demands he is dealing with in his caucus.
Has his leadership been challenged at all since a number of his health scares and his ability to wrangle the votes needed to get this through?
Not at the moment, but there's a growing number of individuals who are saying they will challenge him if he cannot deliver XYZ demand. Representative Matt Gaetz of Florida is saying that he will vote to have a vote of confidence to make sure that Speaker McCarthy is no longer Speaker if he doesn't follow through with, say, an impeachment inquiry. So this is why it is incredibly challenging for Speaker McCarthy, and it's even more so challenging because it doesn't have the support of the Republicans on the Senate side.
Anne-Marie, the president any president comes back from abroad exhausted. That's just the rule of the road. There's going to be a rest period for the President of the United States. What's his first order of work, say, Wednesday morning?
I would imagine the president this week is laser focused on what is happening in Detroit, Michigan. We still do not have an agreement between the UAW, the Auto Workers Union, and the big three car companies, and that contract ends 11:59 p.m. Eastern Time Thursday. That means we could see a strike at one or all three auto companies come Friday morning. This is going to be incredibly challenging for the president because obviously he wants to make sure these auto factories are up. This could have a big impact on car production, on the prices of cars that we've seen recently come down, given the rate of inflation coming down, and it can have an impact on the broader economy. At the same time, he has said he wants to be the most pro-labor union president in modern history, and that would make you think that he is going to want to lean into the support of the UAW. So this is going to be a complicated line for the president to walk, and as of now, there's no contract.
I'm not sure how he maintains that claim without leaning in that direction. Anne-Marie, thank you. Down in Washington, AMH, the latest on UAW, United Auto Workers, making a first move away from this 40% pay demand and dropping it to 36%, the smallest of moves. The Detroit automakers, according to our reporters, Tom, don't think much of the offer at all. That deadline that AMH talked about Thursday night is for nearly 150,000 U.S. hourly workers.
Is this like Disney Charter that before Monday Night Football, are we going to be there Friday, 9 p.m.? Bingo.
What,
deal.
coming in?
Yeah.
You want to do a special?
Yeah, we should do a special. Yeah.
I don't want to come in Thursday night. You can come in Thursday night.
Is it Thursday night or Friday night we come
Thursday
in?
night.
Thursday night, thank you.
Thursday night. We'll deal with this Friday morning. Yeah, that makes more sense. No? Okay. Megan Graper of Barclays is coming up shortly. Your equity market's shaping up as follows. Just pulling back. Session lows here on the S&P 500. We're negative by 0.3%.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
Equity market stocks on the S&P just off session lows. We're negative here by 0.25%, pulling back just a touch on the Nasdaq by 1/3 of 1%. Big event for the Nasdaq a little bit later, the launch of the iPhone 15 in Cupertino, California, later on this afternoon. That's the stock market story off the back of a decent day of gains. We look like this in a bond market. Yields going absolutely nowhere. 428.61 on a 10-year, still stubbornly close to 5% on a 2-year. 499.68, the main event for that one a little bit later this week. Tomorrow morning, CPI in the United States of America. Under surveillance this morning, the latest CPI reading from the US due tomorrow, with expectations that month-over-month prices are rising 0.6% on higher gas prices. Core will hold at 0.2%, according to our survey. How we trade these two stories is going to be interesting, particularly if crude and the commodity rally continues. If you want the latest data in the UK, new data in the United Kingdom shows the highest unemployment rate since 2021 at 4.3%. If you look to wages, wage growth is still close to 8%, Tom, excluding bonuses.
In
Still running at close to 8%.
Wow.
Stunning numbers. Will be very interesting to see how these year-end negotiations go for UK-based companies.
Well, it folds into the UAW story here. My basic perception is Europe and the United Kingdom are radically different than here. And they really have a matter, I defer to the governor of the Bank of England, or I believe Catherine Mann is with Bloomberg today, but the answer is it's different over there. It really matters.
Big time. I'm not sure what Governor Bailey does with that. I want to get you the latest on the IPOs as well. I'm expecting to close its IPO order book early. The public offering is oversubscribed by 10 times, Lisa, according to our reporting. Shares expected to be priced on Wednesday, may come in above the initial range of $47 to $51 per share. Trading, Lisa, set to start on Thursday.
It shows how different it is when you have a business model that makes sense versus a business model that's more speculative. ARM is a solid contender. People want to buy profits going forward, especially in the tech space. Instacart, not so much, right? You're getting a different kind of interest. So the difference between these two point to the discerning features of investors right now.
I take your point that they're radically different, but to me, the whole thing is contrived. They're not selling anything near a majority interest of ARM. It is a contrived marketing scheme to bring money in by selling a little teensy bit of ARM. Thus, you get a 10 times oversubscription. Your 8,000 shares put it over the top. But the answer is, to me, and I'd love to hear from people. Email in, tweet in, whatever. To me, the whole modern IPO process is just a joke compared to what it used to be.
There are two things here. There's one about the actual IPO process. There's another about SoftBank wanting to cash out of a small slice, but not too much to solidify some of the losses, because it still is substantially less valued than it was not so long ago.
Are they doing a service to the shareholders by doing this transaction with a 10 times oversubscription?
It makes a headline, doesn't it? You get the momentum, then you get the pop. You know how this works, Tom.
Exactly.
That's
but
the
it's on
ideal
steroids
scenario.
in the modern IPO game.
I understand.
Are they a SPAC?
Not quite. Stunning pictures out of Hawaii. Kilauea volcano erupting for the third time this year. The eruption started on Sunday after a 2-month pause. The lava, here's the good news, a safe distance from people and structures according to the Hawaiian Volcano Observatory. But Tom, these pictures, the imagery this morning, stunning, absolutely stunning.
I've had the immense privilege of being very close to this by the ocean edge, and it is jaw-dropping. I've never seen that much lava flow. It looks like the season ending of, I think, X-Files.
It looks like a different
Senior
planet.
5. It looks like a different planet. But the answer to me is, how is this like Mount St. Helens, which shattered our modern perceptions? And the pros here have a volcanic explosivity index, and Kilauea is not like Mount St. Helens, say the pros.
Yeah, this isn't going to necessarily be spewing. It hasn't been built up. Have you ever looked at the physics of underwater volcanoes and how they're so much more dangerous than actually above water volcanoes? I was actually looking at this yesterday, that it sucks in all the water and then it throws it out, and it's tidal waves and all sorts of things. It's just fascinating. I love this.
That's how you spend your afternoons. It's good to know.
Well, it was really interesting. It was a cool article.
Sure. This message just came in from a Bloomberg subscriber. This just for you, Tom. I'm feeling kind. Tom, spot on. Small float, sticky anchor holders. Okay.
Thank you.
On the latest IPOs.
Contrived is the only word I've got. It's so far from the spirit of what IPOs are going to be. They should raise the amount, bring in more money responsibly, and find where that proper subscription is. Besides, you're foolishness. That was a hell of a rubber chicken lunch. 10 times oversubscribed. Lots of good birch there from ARM.
ARM is its own beast. We've mentioned this a million times over the last few weeks. Anyway, let's move on.
12 months out. Right now, we're going to move on to, I'm thrilled with the research note. Megan Graber joins us right now. Excuse me, I'm gasping. I'm so anxious to get to this global co-head of debt capital markets at Barclays. Megan, thank you for featuring supply in your research note. Somebody said to me, rates are going to go up. They're not going to provide supply. I said, baloney. What are CFOs and CEOs doing right now? Everybody's issuing, aren't they?
They are. I mean, I talk about tidal waves. I think it's fair to say that our summer is officially in the rear view mirror, and investment grade markets in particular. We've seen just shy of 70 billion of supply in a matter of 4 days, which to put that into context is more than we saw in the entirety of the month of August. And a lot of that is really driven by treasurers, CFOs, trying to front run what continues to be a data-dependent market and trying to get ahead of the central bank meeting on the 20th.
Within your pros sitting on the desk, what is the maturity tip point of that supply debate? Is it the belly of the curve? Is it farther out? Is it in wicked close? Where's that maturity point you study closest?
Yeah, so I mean, it's a tale of two cities in terms of where the bid is gravitating, which is definitively searching for duration in the long end of the curve. I think from a borrower vantage point, those that are electing to move forward, the supply is arguably going to be heavily concentrated in short data maturities as issuers look to avoid locking in higher rates with the hiking cycle likely nearing the end here. So it's proven to be true out of the gates. I think we saw only about 13% of last week's record volumes, 15 years and longer. I think that's a thematic that's going to hold true through the entirety of the month.
The narrative last week was that issuance was going gangbusters and was going at the fastest pace. Some people were tracking since 2010. You put a different tilt on it, saying that, yeah, it might have been front-loaded. There were a couple of strong days, and after that, there's not going to be anything. And you're seeing a really slow September relative to history. Can you put into perspective the nature of the issuers coming to market, why they're coming to market now at a time of higher rates?
Mm-hmm. Yeah, I mean, as you say, it's been a misleading start to the month, and I do think we're likely to disappoint historic September averages. I mean, September tends to be the largest month of the year. I think 2023 is going to prove to be the exception to that, with the street by and large calling for the second lightest September going back all the way to 2015, because I think there are borrowers who are all in yield focused here or taking a view that the scales are really tipped to waiting. The reasons for that are somewhat multifaceted. Some of this is this notable front loading that we saw in the first quarter of the year. There's also very limited event-related financings that are fueling sort of forced issuance into this fall window. So that would be typical of most September numbers. We have an anemic amount of M&A volumes that are likely to look in this side of the fourth quarter. And there's just overarching patience in the face of recent rate moves. Issuers have manageable redemptions. They've got diversified funding avenues. So if you think about the functionality of primary markets across currencies, the euro market is open, the yen market is open, the sterling market is open. So issuers are not beholden to a singular market or to a singular currency to manage their financing needs. So it's containing the size that we're seeing. Somebody like a Nestle is a good example of that. High quality borrower, well loved by the market, did $1.5 billion deal in dollars last week, and they followed suit this week with a deal in sterling. So there's an ability, I think, to appeal to multiple funding avenues to solve for size, and that's keeping volumes at bay.
We're talking about top-rated companies. We're not talking about lower-rated, higher debt level types of companies that have less reliable types of cash flow. From your vantage point, what is the sweat factor in CFOs' offices for some of these more speculative companies that aren't as profitable, that aren't maybe getting the same kind of access to markets?
Yeah, I mean, balance sheets are still in a very good spot. So in fact, the fallen angel volumes that we've seen this year have been a fraction of expectations. So even as we look to the high triple Bs that have emerged this week, it's requiring some incremental marketing. So the majority of deals that moved yesterday that had less frequent issuance into the dollar market and or were cuspier triple Bs, did marketing to get investors up to speed prior to coming to market. But I think there's a comfortability with the fact that rising star volumes have been fivefold what we've seen in terms of fallen angels. So there's an underpinning from a just fundamental balance sheet perspective that's insulating investment grade.
Megan, after the Apple Roadshow today, after they announce earnings, whatever it is, the end of October, I mean, Tim Cook picks up the phone and dials 1-800-MEGAN. Are we going to see another Apple mega deal? I mean, aren't they just addicted to the issuance of bonds to buy back shares?
I'm sure investors would love that. I don't think I can speak to specific issuance. I think the key question we keep fielding is whether or not we're going to see any major reversals in terms of investment themes for names like an Apple or high quality tech companies that have dominated 2023. I think the short answer is not in the foreseeable future. And in large part, that's because the yield story is dominating everything. And the marginal buyer of investment grade credit, irrespective of where they sit on the globe, are compelled by those underlying yields.
Very quickly here, do you see spreads breaking? I mean, the huge surprise here for Bramo has been the idea that spreads have stayed in tight. Do you see any giveaway there?
You know, credit spread volatility is at close to a 2-year low. I think the IG corporate index at 119, it's still within spitting distance of year-to-date tights, but the consensus view is that risk assets are very fully valued here, and frankly, just not sufficiently wide enough as we approach the end of the cycle. But it's hard to be overly bearish over the near term, given the amount of cash that continues to be compelled by the carry opportunities afforded by credit.
Megan, thank you for the update. Megan Graper there
Bonchette
of Barclays. Luca Maestri is the guy over at Apple. Just the CFO is just unbelievable when it comes to supply and issuance.
Why
and
wouldn't
timing.
they? They do another gajillion, 8 tranches. One is a 50-year tranche. They don't go Austria.
Not quite.
They don't. They could.
Hey, the chart of high yield spreads, Tom, is just hilarious. 370 now, near the tights of the year.
I mean, Bramo, this is the oddest market, and that was great. That was a window for equity people. That was a real window into Bonchette, wasn't it? Major Bonchette with Megan.
You know, people look at this and they say, how can I get scared about stocks if bonds are showing no fear also?
Well,
and you look at the fundamentals.
If we've got the time here, I'm still going to say one of the essays of the last 12 months is Lawrence McDonald. I believe I saw it in Zero Hedge, but off his website as
Larry's
well.
great.
Just the wall of money that's out there.
From Bear Tracks.
Is incalculable.
We'll get Larry back on soon. He's great. If you're just tuning in, welcome to the program. The S&P 500 negative here by 0.25%. In the next hour, about 50 minutes from now, we'll catch up with Kathy Bosjancic of Nationwide, and then we'll be catching up with Bill Dudley, the former New York Fed president and Bloomberg opinion columnist. Tom, we'll be doing that shortly. That's one to watch.
James Diamond channeling Dr. Dudley here on Capital.
What did James have to say?
Today. James got upset at the Barclays Summit. He listened to Megan's bond chat, and then Jamie, started in on humility is in order, that government officials are getting a little boisterous in how they're treating said banks.
Did we learn the right lessons from some of the banking failures earlier this spring.
Yeah, he went right to it.
That's
and I
the
think that's
question,
where
right?
Dudley is as well, is, you know, it's so easy to go after people building mega skyscrapers on Park Avenue. I mean, there's no downside.
Have you seen the traffic on Park Avenue because of that mega skyscraper?
Yeah, it's great. Like every
Mr. James Diamond is
boxed around it, everything's down to half a lane.
Being restricted to, yes, maybe a quarter of a lane.
Yeah, a quarter
at
of a lane.
times. Okay,
Yeah.
we'll have that conversation. This one too. Can we talk about lags, long and variable? Jay Pulosky of TPW yesterday called it the lag reaper. The lagged reaper's not coming, he said. Bill Dudley wrote in the last couple of months that maybe we've seen the impact of 5.5% interest rates. We've seen the bulk of the tightening, Tom, and that's already come through the economy, come through markets.
I go to Dominic Constant, 8 months ago, 9 months ago, we're super restrictive with all these other global events impinging on what Jay Powell can do.
New York Fed President, the former New York Fed President, Bill Dudley, is coming up next.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I would love to know what they really want to accomplish. Did they actually learn the right lessons from Silicon Valley Bank and First Republic? Like, you know, I think they have enough authority to tell banks you could take this much interest rate exposure and not that. And that would have solved some of these problems right there. So it was never a capital problem. And so I'm like, you know, what does they want?
The voice of Jamie Dimon, the JP Morgan CEO, speaking at a Barclays conference in New York, slamming a U.S. proposal from regulators that would require big banks to increase capital levels. Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, agreeing with Jamie Dimon. I'm no apologist for big banks. Regulators were right to impose much higher capital requirements after 2008. Yet, there's a point of diminishing returns. Tom, capital is crucial, but more capital isn't the right solution for every problem. The words there of Bill Dudley.
Here's a lesson. Jean-Charles Rocher of Toulouse is the expert on this worldwide, and a major shout out to the Nobel laureate Michael Spence, who was definitive on this, tilting towards what you read there of Bill Dudley in about 2010. Swiss Bancorp was taken out by an upstart Credit Suisse. They're both gone from Fortress Switzerland, which always had high capital requirements. I'm going to opine. Dimon's correct. Enough is enough. Joining us now, Dr. Dudley. He writes for Bloomberg Opinion. Of course, all of his work at the New York Fed in definitive market economics with Ed McKelvey years ago at Goldman Sachs. Bill Dudley, thank you for this important essay. On the calculus of diminishing returns, How efficacious is a lift in capital requirements of our big fancy banks?
I think the question is, what problem are you trying to solve? Was the problem that we saw in the spring lack of capital among the big money center banks, or is it a problem with supervision, problem with bad accounting, problem with bank management? I think the problem is not that the big banks didn't have enough capital. If you remember, money was running towards the big banks during the turmoil that we saw in March, not away from the big banks. And none of the big banks got into any great difficulty in the United States. The problem with raising capital requirements over and over again is you're making U.S. banks less competitive, and that's going to push activity out into the unregulated non-banking sector. The question that creates is, are you actually making the financial system safer, or are you actually making it more unstable?
Should we raise the capital requirements of entrepreneurial upstart banks with a strategic gimmick to build growth?
Well, I think we certainly want to be very close, pay close attention to those banks that are using novel business models. And I think as the Fed itself admitted that we need better supervision. The problems of Silicon Valley Bank were identified in a relatively timely way, but then the supervisors didn't force the banks to make the changes necessary to prevent its demise. So I think that better supervision, more diverse stress testing, better rules on interest rate risk taking could go a long way to avoid these kind of problems. I'm not sure raising the capital requirements of the biggest money center banks by 15 to 20% is the answer here.
Bill, you talk about in your column the importance to recognize non-banking institutions as competitors, and that you really just increase their share by restricting the lending capacity of big banks. Should regulators be basically going down to the lowest common denominator of less regulated non-banks, or should they put more of an eye toward non-banks and regulate more closely some of those activities?
I think they should be focusing on what's the best solution for the resiliency of the overall financial system, banks and non-banks. Obviously, if you increase requirements a lot on banks, you're just going to have a bigger non-bank regime. And the question is, does that make you safer or does that make you more vulnerable? So I think there needs to be balance here. Also, I think that the real question here is what was the problem and what's the right solution to solve the problem? It's not clear that raising capital requirements on large money center banks solves the problems that we saw in March of this year.
Can we say that the banking crisis is over to the extent that it ever happened, and that going forward this is not going to be some sort of bigger financial risk that could torpedo the Goldilocks scenario, at least for the moment?
Well, you never know, but I think that so far the knock-on effects of what happened in March are pretty modest. I think that's because it really was concentrated in a few banks, and it was all happening in plain sight. People knew exactly why these banks were getting into difficulty. They could see their interest rate risk exposure. They could see what's happening to their capital on a mark-to-market basis. So this is not like the great financial crisis where everything was happening in the shadows. People lost confidence in their counterparties. So I think so far, at least, it looks like this is a pretty modest knock-on effect to the real economy.
So if that's the case, and that isn't necessarily a headwind going forward, do you lean into this idea that maybe the Fed should be done, and that we are looking at a scenario where they have the opportunity to just wait and take a look at the data on a longer and longer term basis to make any decisions?
I have no quarrel with the Fed waiting to get more information. I mean, they're pretty confident that monetary policy is at a restrictive level. If that's the case, it should slow the economy down. As the economy slows, we should have more slack in the labor market, and that should take away some of the upward pressure on wages and bring inflation down. I think the key question is, how restrictive is monetary policy today? It's possible that monetary policy is not quite as restrictive as the Fed thinks. And if they find that out over time, then they can obviously do more or keep rates higher for longer.
Bill, I want to finish there. You wrote about this earlier in the summer. I don't think it was picked up on nearly enough. I've been talking about it as much as I can. This quote from your column that read as follows, and I had the quote ready for you, Bill. There's considerable evidence that lags have shortened, meaning that the economy has already felt nearly all of the impact of the Fed's actions. Bill, talk to me about that evidence. Where do you see that evidence currently?
I think the most obvious piece of evidence is what's happening in the housing sector. The housing sector, obviously was hurt a lot by the backup in mortgage rates from 3% to 7%. But recently, the housing market looks like it's bombed out and isn't having any further weakness because of the rise in rates. The other thing that's important to note here is monetary policy works faster than it used to because the Fed uses forward guidance to guide the market, not where it is today, but where it's headed. So financial conditions, most of the tightening in financial conditions that we've seen over the last couple of years happened last year, not this year.
I remember, Bill, a conference that you and I did together with Mohammed Al-Arian in the summer of 2021. I think it was early summer, around June time. And you were both talking about how inflation may well be stickier than people think. And I remember you, Bill, threw out the number that maybe rates have to go to 5%. 5% back then sounded absurd. We're through 5. We're through 5. And we've gone right the way through 5. Bill, what are you thinking about now? Best case on where you think sufficiently restrictive might be?
I think that it's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think is going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think. And I think that's one of the things that is feeding into the bond market and why bond yields have moved higher.
Bill Dudley, thank you, sir. Former New York Fed president and Bloomberg opinion columnist. Some fascinating insight there, Tom, on the regulatory backdrop around the banking story, but also on how far this Fed might have to go, and how high they might have to stay at these levels, how long they might have to stay there through next year.
Well, that's a monetary ballet, which gets, 98.285% of the discussion here as well. And you see it, with Lisa's wonderful patience and this Fed speaker and that Fed speaker and all that. There's a whole other part of the Fed. And what Diamond's screaming about, and he's got a lot of company on this, is this conflation in people's mind of regulation, like what are you going to do with the big banks, versus supervision, which is go out there and look what they're doing. And this conflating of regulation and supervision is the heart of the matter. Again, Rocher at Toulouse owns the high ground on this, and we failed. And Diamond's 100% correct.
Just to put a bow on that, a supervisory failure, not a regulatory failure.
Yes, thank you. Excuse me.
No, you took us there. I just wanted to get to the headline. Tom, great guest for you to speak to all of this about Bob Michael at JP Morgan. You can ask him everything about Jamie's thoughts in the last 24 hours.
He's not going to talk about it, I mean, he wrote the script for Diamond, we know that, but, Bob's not going to talk about that. I mean, is Salah still at Liverpool?
He is, yeah. He wasn't sold.
At least this week.
Yeah, the transfer
Maybe
window
Bob will talk about that.
Closed in Saudi, so Liverpool keep their man. That's the good news, I guess. He might have something to say on Everton.
Is the Merseyside derby, is that Everton and Liverpool?
It is, yeah.
Oh, okay.
The blue and red sides.
How many miles apart are they roughly?
Pretty close, same city.
Okay. I'm learning.
You are. Every day. Every day. But Michael, JP Morgan
I got my
Asset
Everton bow
Management
tie on.
joins us up next. Bullish bonds. Is that what that was for?
Yeah, that's
Everton?
what it's for. We got a chairman of the board, which is all Everton, so I'm all Everton.
You keep referring to this. Is Mark Carney an Everton fan? I didn't know this.
Yeah, he called me up the other
since
day.
When?
He's like, huge. I don't know. He's been an Everton fan since whenever.
Where does that come from?
I don't know. I said, can't you go with the Tots? And he said, hell no.
Everton. Oh, I didn't know that.
Yeah.
King was Aston
Know
Villa.
your chairman. Rule 1.
Yeah, I mean, that's some good advice, TK. Some good career advice.
How about that UNC football season? It's just great.
I'll get in touch. I'll try and work that out. From New York City this morning, good morning to you all. Equities on the S&P lower here by a third of 1%. This is Bloomberg.
You have big plans to expand Visa's business in Africa. Tell me about them.
Well, this is one of the most exciting places in the world, and we believe that it has only really begun. There's been so much progress in the last couple of years, the last 5 years, but the progress that I see and the possibilities I see for the next decade are incredible.
Why Africa now?
There's lots and lots of opportunity here. So this is a time and place where I think the infrastructure has advanced. It still has ways to go, but it has advanced that it creates a good on-ramp for us. And we heard yesterday from the Secretary General of AFCFTA. I think that is a critically important platform. This idea of taking a pan-African approach is critical for companies like ours to invest, because we can count. What we're trying to count on is having a level of standardization and interoperability across the continent that makes it easier for us to invest in a broad-based way as opposed to having to create bespoke solutions in 54 different countries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I do think that the recession risks remain out there.
There does seem to be a lack of upside catalyst. We've got a long way to go before we can sound the all clear on inflation fight.
We need to be very careful about reading too much into a single data point.
I think for the most part, it's going to be wait and see, at least for this week, ahead of FOMC next week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We begin the week with Apple. In this hour, complete curbside coverage, Bloomberg Technology, and Cooper. Ed Ludlow will be there, I believe.
Promo's going well. Keep going.
You know, it's great. I mean, Ed Ludlow's going to join us in this hour about Apple foolishness. Let's clear that out of the way before we move to serious stuff. It's a product launch.
It is. The
That's all
iPhone
it
15. Apple captures just about every big story out there right now. I think from my perspective, the tension between the US and China, the competition you're getting from foreign brands, Huawei, and cost pressure here domestically in the United States. If the consumer is weaker, can it cough up higher average selling prices over at Apple? TK, that's going to be the test for the consumer later on this quarter.
Are we going to learn about those distractions today? I don't think so. They're going to stay on script.
No, this is
smiley,
the marketing,
smiley.
the happy stuff, smiles and all of that good stuff. But what we want to know is, are you moving more to India? Are you moving away from China? Are you in China for China? And how much can you sell to that country? And is that Huawei, what was it, Mate 60 Pro Plus and all of that good stuff? Does it have the capacity to compete with you at scale in the world's second largest economy?
The Bramo fam is all Huawei. They're looking at it carefully. I mean, Lisa, the foolishness of this, the reality is it involves gajillions of dollars. It was a $3 trillion company.
Well, also, isn't the whole story of this year in the stock market kind of a big product launch with ChatGPT and artificial intelligence?
Good. Yeah,
I mean, if we're looking at this idea of what's been driving the momentum in U.S. equities, it has been on the heels of products in the tech world. So that's why this is actually more important potentially in signaling
Right.
not only, you know, the bottom line for Apple, but going forward, artificial intelligence. What's
Right.
the future of computers? Are we all just going to be wearing goggles and sort of dancing around?
Now, what we do is we have the different conversations here on Bloomberg Surveillance. We're going to do bonds, bonds, bonds in this half hour. If you're part of Global Wall Street, Bob Michael will join us here in a moment. But, John, I got to go to the tag team equity moment we had this morning of Greg Bowdle, bear, lifting, and Stuart Kaiser, enthusiastic, reaffirming enthusiasm out into 2024.
So let's talk about the bear. Goes from 3,400 to 4,150 on the S&P. Was the biggest bear on Wall Street, now just slightly bearish on the S&P. Well, Stuart Kaiser of Citi had to say, good news is good news.
Thank you.
Very, very clear about that this rally has been built on good news, better news in America. And if things start to sour, then his view on the equity market will start to sour as well.
I think our conversations are so important. Let's do a speed data check. John, the real yield, 1.94%.
Bonds look like this, Tom. 10-year, 428.21. Yields just about unchanged. We've got a bond market bull around the table with us, so we'll get to him in just a moment. In the equity market, equity futures TK just a little bit lower, negative here by 0.3%.
Bob Michael joins us right now. He is with J.P. Morgan Asset Management, global head of, well, equities, bonds, currencies, commodities, I don't know, everything else.
Let's stick with bonds for now.
Let's stick with bonds for right now. Do you buy across the curve right now? Because simplistically, it is going to be price up, yield down.
So the product launch of the year isn't ChatGPT, it's the bond market. It's the repricing of bonds just across the system. And we are seeing money come in. And even though there's a soft landing cap, there's concerns about inflation, there's concerns that the Fed could keep rising rates indefinitely, actually, the highs from October, almost a year ago, have held pretty well in the long end of the curve, 5, 10s, and 30s. So it's not just me saying take advantage of the repricing of the bond market. We have clients left, right, and center, domestically, foreign countries, retail platforms, institutional platforms, looking at where to get into this bond market, and they are putting money to work.
Are they chasing income? Are they chasing total return? Worried about a slowdown, taking on duration? How has the nature of that money shifted in the last few months?
Yes, exactly.
All of the above.
They're doing all of those things, and it depends where they're coming from. Wealth management platforms are looking at municipal bonds, they're looking at corporate debt, they're looking at treasury debt, and they're putting ladders of maturities in place. So they're buying bonds out to 10 years with maturities every 6 to 9 months, something like that. So they just want to get into the bond market before these yields disappear. Institutions, whether they're insurance companies or their pension funds, they're looking at their liabilities having deflated, and they're looking to put money into the long end of the market, and you have a whole host of others that are looking for total return. So you can do pretty much everything in the bond market. We haven't seen this since 2006, 2007.
There's only one sentence I heard in all of that: before these yields disappear. These yields aren't disappearing. They've been quite stubbornly high through summer. That's been unexpected for you, I know, Bob, relative to your call. What do you think's behind that?
Well, I think there are a couple of things. This reminds me a lot of the second half of 2021 when yields were ridiculously low. The Fed was talking about transitory. The market bought it. We were looking at inflation going up and saying, if they leave rates where they are, inflation's going to continue to accelerate. Now we're looking at rates very high. We're looking at very high real yields. We're looking at inflation coming down a lot. And the Fed is talking about leaving rates where they are indefinitely, higher for longer. I want to see the summary of economic projections. Is it tomorrow?
Next Wednesday.
Next Wednesday.
Yeah.
And the infamous dot plot. They've got 100 basis points of rate cuts priced in for next year from the last dot plot. And they've also got inflation coming down. So they're acknowledging that if they keep rates where they are and inflation comes down, then policy rates become progressively tighter and the economy may not be able to withstand that. I think what's keeping rates where they are is the market is believing the Fed rhetoric and not believing that they may have to cut rates.
Your previous call at the start of summer was cuts by September. Clearly they won't be cutting a week tomorrow. I want to understand from your perspective what's going to deliver those cuts. And when you're thinking about yields we haven't seen since 06, 07, some people might be listening this morning thinking, well, bad things happened after that. Do bad things happen now? And of course, I'm not saying on the same scale to the same magnitude of what we saw in 08, but are you anticipating bad things?
So at the start of this year, we thought something like recession by the end of the year. Then we had the regional banking crisis, and we thought, well, that's going to bring recession forward a few months, so they should be cutting by September. And I think what we looked at and probably got wrong was the backstop that the central banks, the Fed, put in place, the Bank Term Funding Program. And we likened it more to a Bear Stearns bailout. It probably was more like TARP. It just created more liquidity, backstopped the entire banking system. These things are still hiding in plain sight. The regional banking crisis hasn't gone away. I wish you had asked Bill Dudley when he was patting himself on the back in the Fed about, no, this is all in the rearview mirror. Really? Look at the Bank Term Funding Program. It's quietly increased in size the last 9 consecutive weeks. It's at $108 billion. So the regional banks are not working down their borrowing, and that's coming in at 5.5%. That's telling us that they still need cash available to meet depositor outflows. So I think there are plenty of things out there that are slowing down. Growth and inflationary pressures are coming down. For the Fed to pause, we've said for a long time, you need disinflation and inflation to come down to levels they're comfortable with. I think tomorrow we're going to get the third consecutive core CPI print at 0.2. That's enough for them to pause with a lot of the other disinflation that we're seeing. I think this time for them to cut rates, they're going to have to see unemployment go up. So it's possible that they may actually tip the economy into recession first before they start cutting rates, which would be something new for them. It would be positively ECB-like.
Well, okay, but going forward then, how does this cohere with a 3% yield curve across the board, a flat yield curve in the near future, by the end of this year, or even by mid-year next year? If you have a Fed that's being patient, not willing to cut, and you have economic data that's coming in hotter than expected.
Well, this is the Fed that promised us transitory and then within a couple months changed their mind and started hiking rates. We think we're going to see the same thing this time. They're going to tell us that they're going to keep rates higher for longer until inflation is at their target. But the magnitude of the slowdown we're seeing across the board tells us that we'll probably still be hitting recession around year end, so they'll be cutting rates by then. So I'm still incredibly comfortable that we'll see 3% across the curve.
Do you think high for longer is just a bad call, or do you think they're just misleading us that that's what they want to signal currently?
I think it's what they have to signal, because they were already wrong once on inflation with the promise of transitory. They can't be wrong again. They're telling us that they're prioritizing inflation over growth, and that means, like the ECB, you're willing to make the economy a casualty.
I guess what I'm getting at is, do you believe them?
Do
you believe they're prioritizing inflation over growth? Or
No,
at the first sign of weakness, do you think they back away?
Well, I think the consumer is incredibly stretched right now. When you look at the Beige Book, you're seeing signs of that all over the place. They're talking about the last bit of pent-up spending on leisure travel. They're talking about consumers that are trying to maintain their level of spending since their excess savings have run out by putting stuff on borrowing, which is a very high way to finance yourself. So things are going to slow down pretty quickly. We look at news coming out of Truist where they're starting to address cost pressures by laying people off. So the labor market doesn't look as robust as that mid-threes unemployment rate. We think that starts to go up, and it will force the Fed's hand.
Let's dig into that in about 5 minutes' time. Bob Michael of JP Morgan Asset Management is going to be sticking with us, TK, for a second segment to get into the latest data in America, into CPI tomorrow morning.
Well, it's a data flow that we're seeing, the data dependency that we're seeing. I got like 8 questions for Bob Michael. It's good that he's going to stay around for the half hour, but you know, to me, it's just simple. We're completely data dependent starting tomorrow.
If you're just tuning in, welcome to the program. Equity futures on the S&P negative here by 0.1%. 0.3%. Coming up shortly, a second round with Bob Michael at JP Morgan Asset Management. Tom's going to deploy at least 4 of those 8 questions, Tom.
Yeah, Jamie Dimon gave them to me. He's so fired up. He said, ask Bob this.
Bob's got time at a commercial break to run now.
Yeah.
You're going to squeeze a Liverpool one in there as well?
We got to. I mean, I'm fascinated. Bring me up to date. I adore Salah. He goes mental. He goes right for the net. It's just a joy to watch him play. He's with Liverpool, but there's still this option he could go to Saudi Arabia.
Well, that transfer window is closed now, Bob. So
but
that
they'll
threat
reopen
for now
it for a
has
gajillion
gone away.
dollars.
For now, do you think that threat comes back a little bit later this year, next year?
I think it does. And I think the lure of Saudi could be appealing to him and to Liverpool, but they've got a deep team now. They've got a lot of scorers. They look very lively up front. They're not dependent on one player anymore.
Your opinion on Nunes has changed overnight, seemingly. He's like the man now. You're comfortable with him leading the attack?
They've got more than just him.
Okay. 8:30 Eastern Time, Kathy Bosch-Jancis of Nationwide Mutual Insurance will be joining us. So that conversation is 17 minutes away. We'll have another round of conversation with Bob Michael at JP Morgan Asset Management in about 5 minutes' time. Just to set up your trading day, equity futures here are negative by 0.3% on the S&P 500. Going into that launch of the iPhone 15 a little bit later on this afternoon. Apple in the crosshairs of US-China tension, driving a stock lower last week by about 6%. The weight on Tim Cook's shoulders going into this launch. Trying to sell it here, TK, for Ed Ludlow and Caroline Hyde. The weight on his shoulders to make this iPhone 15 a success has never been bigger.
Fanboy's with us this hour, right? Fanboy's with us?
Is Ed fanboy?
He's fanboy.
Ed
Wicked
Ludlow's
fanboy.
coming up in about 30 minutes' time from New York. This is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We've always had a recession in 2024. We're moving perhaps away from a recession in the early part to more the mid part of the year. But, you know, if the recession is still very much in the cards, and if that were to play out, I think you should start seeing a moderation in yields, or the sell-off in yields we've seen at the back end.
Subhadra Japa, the head of US rate strategy at SocGen, with yields near 4.30 on a 10-year, near 5% on a 2-year, and the threat they go higher off the back of this move in the commodity market. Brent crude, new high for the year, $90 and about 60 cents, $91.50 is the new high for the year. Where we are right now is 91.45 and up by 0.9%. 5%. This headline right here. Thank you, Grant Smith, over in London, for writing up this story. Global oil markets face a supply shortfall of more than 3 million barrels a day next quarter, potentially the biggest deficit in more than a decade as Saudi Arabia extends production cuts. Just a little bit of a push higher off the back of that headline, Tom, moments ago.
Francisco Blanche giving us the microeconomic foundations of oil, and he said, we're here, we're where I want to be, and he set out the microeconomic case, supply and demand, to get to 100.
Headline inflation tomorrow will speak to this story. High gas prices. Core won't. The issue that I think we've all got, the question we're asking, Tom, is how much attention the Fed pays to this a week tomorrow.
They're going to look at I think they're going to look at the aggregate data. David Rosenberg's been a great student of this, and that there's this, but Lisa, I think, has been on this. The answer is oil, and a gallon of gas is a political instrument in America.
And at a certain point, as oil prices go higher, it influences prices in other areas. And that's sort of the issue. And it really gives people the appearance of inflation. So it raises this question going forward. Does the Fed use that more than they think?
To me, it's behavior. I mean, if I'm where I'm living and I never go below 59th Street, I mean, that's an example.
Except every day when you come to work. But yeah, sure.
Okay, half a block. But I've been down to Soho in 14 years. But the bottom line is, the bottom line is, if I'm at the Jackson Hole Economic Conference, it's nothing to get in the Suburban and drive to the $1 Million Cowboy Bar, which is like a gazillion miles away.
Speaking about your own life,
and that's the way the rest of America is.
I hear you. They drive a lot.
They travel a lot. That's all there is to it.
The gas price means a great deal. It shapes their views on where inflation is and where it will be as well. That's the difference, Tom. It shapes expectations too. You see that in New Mitch quite a lot. The correlation between expectations and where gas is right now.
Out to a new high on Brent, 91.50 printed moments ago. We continue with Bob Michael of JP Morgan Asset Management. What I was thinking about, Bob, and this goes back to the acclaimed toughest resume, toughest admit in banking, the analyst program of JP Morgan, is the real yield we're at right now began within the data that we have in the modern age in 2003. And that a huge body of our audience has never lived this rate structure and all of the follow-on to it. What's your counsel to someone, say, under 37, 36, 38 years old, of how to address a whole new world after all?
Well, I think you have to understand that markets go through cycles. The cycles can be very long. Probably the last 15, 20 years weren't normal. They were the distorted years. They were the years that the baby boomers wrecked by over leveraging the property market, crashing it, and then taking a decade to repair. We think we're going back to an environment that is more normal, where there is a demand for capital, there's a use for capital, it's productive, and there will be a cost for capital again. But you don't get there all at once. I think a 525 basis point rate hike is a shock to the system. It will slow things down. We think the next move coming out of the Fed will be to cut rates. We think you go back to 2.5% to 3%. Yeah, the next tightening cycle, maybe they have to go to 6%, and you start putting in place the mirror image of what we saw in the late 80s and the 90s with falling rates. You may now see rising rates. So we have to get them used to inflation can be real, and markets have to price that in, and central banks don't always bail you out.
There's a lack of clarity in terms of how central banks really understand inflation. They say they look at core, and then headline starts to move sentiment, and then they start going after that. How much do higher oil prices, materially higher oil prices, play into the risk that the Fed remains higher for longer?
There used to be a wonderful chart everyone would dust off every time oil prices went up, that oil shocks create recessions, and it was another one of these 100% perfect predictors. And we're getting another oil shock at exactly the wrong time. After credit conditions have tightened dramatically, after the cost of funding businesses and households has gone up a multiple, we're talking about business and households having to spend on energy at a time when their real incomes are much lower. So they're going to have to cut back somewhere else. I think it actually is another one of these things that's a warning that recession may be more present than the market thinks.
When does it count as an oil shock? Because we are seeing prices normalize. They're not necessarily going to the highest that we've seen of this particular cycle, but they are the highest going back to last year. What's your tipping point for when it is prohibitive of growth?
Well, you have to look at the cost of production and the cost of getting a barrel out of the ground and where we are now. And what we're seeing is that OPEC is telling us maybe demand isn't quite there, but they're not willing to live with much lower oil prices. They want the volume to replace the demand. It's not there, so they're going to make it back with pricing, and they're going to push prices up. We'll see how high it goes. But for me, it's another sort of yellow warning flag out there. I don't think it helps the economy at all. I think it's another thing that squeezes an already stretched consumer.
Bracket the inflation-adjusted yield right now. At what level up above 2% does it really begin to impinge on the system?
I think coming off of several years of infinite free money, we're seeing it bite right now. We're seeing it in the housing market. We're seeing it in the cost of funding credit card purchases. You look at businesses, they front-end loaded a lot of their borrowing, but now they're going back and they're addressing other cost pressures. And they're not doing it by just borrowing more and absorbing the cost pressures. They're actually starting to cut costs. So I think it is now starting to bite. I don't think long and variable lags to monetary policy, that law has been repealed. I think it still takes time, and we're still in the early stages of it. I think the next 12 months are going to be pretty painful.
What would you have to say to make you change your view?
I'd have to see a legitimate reacceleration of core inflation. And that would tell me that we're in a different regime. Maybe the XYZ generation is large enough, they're earning enough, they're spending enough, that it is driving an economy that is going to a new high, and central banks do have to come in and really dial down the desire of the consumer to spend. But right now, we're not seeing that.
Are you Googling the XYZ generation? Is that what you just did?
Yeah.
What are you up to?
What is the XYZ generation? I've never heard of it.
XYZ?
It's the X, the Y one, and the Z one.
Yeah, no?
Gen X,
okay.
Gen Y.
Oh, like combined together.
Gen Z.
So, yeah, so think the 91 births. The 91 births are now the largest population cohort, and they're 32 years old. So that's the one. And if we go back to the financial crisis, they were 17 years old, and we wondered, how will we get through this before they replace the baby boomer as the dominant consumer? Now we're there. That's where we could be wrong. I don't think so.
They're the crew that, after the second REM album, they were never the same.
Thanks, Tom. Yeah. Bob, thank you. Bob Michael,
pleasure.
JP Morgan. I've got the official statement from Alarian on the Jets if you want it.
Oh, please.
So diplomatic, just writes in. The Jets showed inspiring spirit and determination, overcoming an early setback that would have derailed most other teams. We will remember this incredible win for a long time.
Oh, my God.
That's so official, isn't it? From Mohammed. Is that
well,
him
he's at the
auditioning
He's at the 50-yard line.
Does that sound like a man who owns the club? That sounds like a man who owns the club, doesn't it?
Yeah,
Might be the future chairman of the Jets. Is that what's next for Mohammed?
Yeah.
Potentially.
He wouldn't give us tickets, but hey,
That would be nice, though, if he did give us tickets.
His seats are unbelievable. They're like
I've seen
4
them.
rows up,
It's ridiculous.
50-yard line. It's like he's like a rock
hardly
star.
ever there to sit.
You can see just above
I know.
Aaron Healy on the sidelines.
I know. Bob, thank you. It's good to see you. Coming up on the Open, Chris Harvey, Wells Fargo, Cameron Dawson, New Edge, Vichy Rapporteur of MorganStanley, and what we call in Ed Ludlow, Fanboy.
Fanboy
from
there.
Cupertino,
He's got
California.
a black turtleneck on.
The iPhone 15 in New York. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
At Bloomberg Surveillance, how do you listen to what we do? We're going to pause here in the modern digital world and say, what do you do after the show? And thank you for watching us on Bloomberg Radio and Bloomberg Television. The first thing you do is read the Bremo letter. It's the Bloomberg Surveillance newsletter. Lisa, tell us about this. The people, Ray YouTube and the others that keep track of this say this newsletter is successful.
Well, it's basically that if you don't catch all the interviews, pulling together snippets. And I will say that people say such fascinating things, and it can get lost, but they speak to each other, which is one really cool thing that I enjoy. That people kind of weave together the day's narrative together.
Yeah, Lisa and Ed Duffner are going to team of like 7 people, 3 interns putting this tome together. It goes on pages and pages. And of course, on Bloomberg Digital on YouTube, look for our conversations. Stuart Kaiser on the market. Bob Michael, they're just brilliant on how the new bond market is the old bond market. With that in mind, in charge of all of our economic coverage, international economics and policy correspondent Michael McKee joins us. The next 48 hours, CPI is a big deal. I get it, but I got to dovetail it with the day later retail sales. Piece the two together. Inflation report, consumer report.
Well, the consumer report obviously is influenced by the inflation numbers because then
it's
nominal. It's nominal numbers. It's artificially increased. So it's more the trend that people want to see. And when I say people, I'm pretty much talking about the Fed and then anybody on a trading desk who's trading the Fed. And at this point, they're expecting a reasonably good month for the month of August with retail sales up a little bit, but not going forward. That's the question. What happens as we get into September, October, November? And a certain amount of that will be determined by CPI prices, particularly, you've been talking about it all morning, oil prices, the fact that they're going up and they'll push, at some point, gasoline prices up significantly. So the interesting thing about that is we can wring our hands all we want, but there's nothing much that anybody can do about it.
Well, but it would be great to get your sense to build on that of how the Fed views oil prices, energy prices as an input, given the fact that it is inflationary on a headline figure, but does remove money from the discretionary pot of spending.
They could raise rates all they want. It's not going to change the price of oil. That's the problem for them. So they have to kind of look through it. They tried in the 1970s to be accommodating lower prices, lower interest rates in order to give people more spending power as gasoline prices went up, and we saw how that worked. So they're not going to do that again. I guess part of the question now is going to be when we get to CPI tomorrow, how much does headline matter to people versus core? Because the core is not expected to have gone up any faster, 0.2%, and on a year-over-year basis fall to 4.3%, which would be considered good news. And the Fed's going to be looking more closely at core. But after a while, if energy prices keep going up, it will feed into the core as well.
How many is the new data dependency when it comes to the number of months you have to see before Fed officials start to care?
I would hesitate to put a number on it. They use the old pornography Supreme Court defense. They can't describe it, but they know it when they see it. A couple of months is of increases would put more pressure on them to raise rates again. It's going to be very interesting this month to see what the SEP, the Summary of Economic Projections, and the dot plot show. Do they still keep that last rate increase in there to keep the markets from thinking that they are done?
Michael McKee, with an eventful 48 hours coming up. We'll look forward to that. And of course, he'll go beneath the headline data tomorrow at 8:30 on CPI, core, this, uncore, super core, whatever it is. I can't keep track. One who can keep track is Kathleen Bisjoncic, chief economist at Nationwide Mutual Insurance. Let's begin there, Kathy. Jerome Powell talks about the Dallas Trim Mean. I'm partial to the nationwide Cleveland Inflation Index and the rest of it. Which inflation series do you follow to get a feel for what America is feeling from inflation?
Oh, good morning, Tom. Happy to be with you. Well, I look at all of them, but I think, Mike's comment was quite noteworthy in that the headline, so with oil prices rising again and putting upward pressure on gasoline, the consumer, for some period of time, may even also look through these higher energy prices and say, okay, this doesn't mean that inflation's picking up overall, but if it continues, that could lead through to inflation expectations. And again, that's still a worry for the Fed Reserve because inflation overall is still high. Less of a worry because we've seen some nice disinflation. And as you mentioned, the super core inflation, which is core services ex rents, that has started to roll over, especially the 3-month annualized. But the core, if you really want to boil it down simply, it's really the core CPI measures right now that matter the most. Assuming we don't see oil go through, $100 per barrel.
It's a dual mandate Fed, and I got 3-month annualized forms of unemployment and jobs coming down nicely. Is the job market broken? Are we finally moving down to new levels of a lower non-farm payroll?
Well, far from broken. It's still a very strong labor market, but it seems to be cooling, and it does seem that the Fed's getting its way here. It's removing some of the demand, some of that froth, and yet, not crushing the economy. Time will tell how this plays out, but you even see the wage growth numbers, cooling. So I think the odds for soft landing have gone up. We ourselves are a bit more cautious, but we've trimmed the recession shortfall. We now think it's more of a mild instead of moderate. We have to be, reflective and respect the incoming data that inflation does seem to be moving, downward more quickly than we thought.
We were speaking with Claudia Sahm yesterday, formerly of the Fed and the Sahm rule, and she was talking about how we just don't know yet. We're holding our breaths, trying to understand whether the decline that we've seen in some of the employment momentum is just a softening or whether it's the beginning of something more protracted. How are you viewing this? How are you looking at this to understand which it is?
Well, I agree with Claudia. We definitely, need time. But the recent blip up in the unemployment measure was really because more people came into the labor force. The labor force participation rate, as you know, went up. And particularly when you look at what they define as the prime-aged workers, 25 to 54, we're back over the pre-COVID level. So that's a sign of a very strong labor market. You're pulling people in. The fact that the unemployment rate went up is just because job growth couldn't keep pace with that. It's still not a weak labor market. That said, the fact that the Fed's going to hold rates, we think, steady, and as other guests have talked about, as inflation comes down, the real Fed funds rate goes higher. That's where the restrictiveness comes into play. But I think at the same time, if you do get inflation coming down, it just takes some of the pressure. And in real terms, growth is higher because of that, right?
Kathy, there's also this lack of clarity around whether there's a structural shift in the labor market. We'd been talking about that a number of months ago about how, there just were fewer workers, and so you had to pay up in order to get anybody in the door. How does the UAW potential strike, the negotiations we've seen there, we've just heard from UPS yesterday on Bloomberg Television talking about how the increase in wages and the agreement that they came to is going to impede some of their profitability, but going forward, this is the norm for them. How does that shape your view about what we can expect, the stickiness of wages, regardless of how much the jobs fall, et cetera?
Yeah, and a great point. And it is, that is the risk that we do get that stickiness still in wage growth and inflation, as talked about, maybe going from 9 to 3% on inflation was sort of the easy part because of year-over-year and energy prices, until recently coming down, but getting the core and especially service prices to moderate even further, and wages play a big role of that. So it's something we're watching very closely, and it's definitely, it plays into that whole profit margin squeeze. That's why we still have a recession. We do think the profit margins get squeezed, but it's just not going to be quite as large of a shortfall as we thought previously.
You explained beautifully the complexities of our labor picture. Are the dynamics, the plumbing of how we look at the labor economy, is it a similar study to what you would have done 10 years ago or 20 years ago? Or do you have to have a whole new outlook on labor dynamics in America because it's a new America?
Yeah, that is a great question. And yes, you do look at it differently now because the backdrop, we have the demographic change rate in America. We have the aging of our society and the baby boomers continuing to retire. That's playing into this whole labor shortage. Yes, we have a labor shortage because cyclical forces, but also secular. And that is not going to necessarily go away. The question is how that is really handled by corporate America. Can they continue to adjust? And what we don't know, the big question is what happens with AI, right? And AI generative, does that replace some of the shortage of workers? And is it already doing that? So it is a very different dynamic. We never saw job openings relative to the demand for workers relative to the availability be this strong. So job openings relative to unemployment is still very high. And we've not seen that, historically.
Kathy, are you going to be watching the Apple launch, the event, the marketing event, as Tom says, at 1 p.m.? And basically are some of these product launches macroeconomic tools to understand the future of just some of those instruments?
Well, I have to say that myself, but particularly my younger son, is really very excited about these new launches. So if we don't catch it live, he shows me how to find it on YouTube. So I'll watch it one way or the other. But it is really exciting. And I think certainly in general, innovation, creativity, these are important. And obviously Apple being one of the big performers up until recently, some of the issues with China. But in general, what we're seeing really like the top 10 stocks in the S&P have generated 80% of the gain of the index. It's pretty concentrated, right? And pretty impressive.
Kathy, thank you so much for the brief on the American economy. Kathleen Bostjancic with Nationwide. Kathy and I go back years, and I love talking to her because of the knowledge and the granularity underneath the headline data that we blather every day.
Well, I also love that her son also makes her watch the Apple launches and really get her excited about the products that she will then be encouraged to buy.
I would take it to the international acclaim. And this is, of course, the debate here of the new cord that goes into the new iPhone. Is we have that effervescence, what Ned Phelps would call dynamism, and they don't, and that makes for the American difference. Interesting market, percent change in the Standard & Poor's 500, a negative 0.2%.
Coming up, we are going to take a look at what to expect from this particular
We're actually
event.
gonna do it.
Well, look, you call
He's
him
awake.
fanboy,
He's
which I'm
awake.
guessing is
He's awake.
completely abhorrent to him. But I will say, look, this is a big deal, not for Apple per se, but because it's such a big company in the S&P 500, in the NASDAQ, because it is such a big aspect of the U.S. economy at this point, and because of AI and generative intelligence.
My observation on this, and I've always tried to not be a fanboy, even though there's a zillion Apple things at home, is what's different now, and I didn't expect this, is Apple is cool with the kids. For years it was Android, only the old farts like you use Apple, and that's changed. And I did not expect that. And, it's not Huawei. Samsung's basic, I saw a chart the other day, it's shocking, the deterioration, but Apple's, because of the ecosystem, is cool.
Yeah.
I did not expect that.
Do you have cord wars at home? Like where people take each other's cords?
No, what we do is Dad buys more cords. So we have so many cords.
This is a real phenomenon.
The dogs chew on the cords and no one cares because there's another 5 cords to replace the one kennel fee.
The way you describe
kennel fee's the worst.
The way you describe your house, it's sort of 45.
Oh, you have no
just
idea.
Completely mismatched under the couch, and then you've got cords that are chewed up, lying everywhere. People yelling.
Yeah, Karen from Sydney knows this. We serve martinis at the front door.
I could guess
it's that bad. KB knows that. There's no question about it. Futures -9, Dow futures -24. Coming up, the most anticipated conversation of the day. Fanboy joins us from Cupertino. This is Bloomberg. Stay with us. Must watch, must listen.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's hard to get away from tech. There is this structural growth story. So if we're in an economy that is slowing, albeit at a more gradual pace than we anticipated, then the structural growth stories are those that are going to outperform. The issue with tech is how far it's rallied this year. So I think the story going forwards in tech is going to be about being more selective.
Greg Bottle, U.S. Head of Equity and Derivative Strategy at BNP Paribas, earlier today as he talked about why he's abandoning some of his bear call, but also the dominance of tech ahead of this Apple event, the marketing event. Tom Keene alongside me, John Farrow off at his 9 a.m. property preparing for that. But really, right now, before we get to that, I want to just talk about oil, hit it quickly, because we are looking at $91.51 Brent after this announcement by OPEC that there's going to be a 3 million per day barrel per day shortfall in total production on the heels of what we heard from Saudi Arabia.
West Texas Intermediate 88.52. I was just a 90 print on American oil. We're not there yet. Would be really something as well. You got some movers today?
Yeah, I just wanted to take a look at at some of the other stocks, and I really wanted to focus on the tech world. Oracle yesterday coming out and reporting earnings that were disappointing, in particular their cloud forecasts for their cloud sales. There had been such high hopes that it really explains why you're having such a significant drop, almost 10% at this point. It was 10% at one point, which would be, if it holds, the biggest fall since March 2020. Tesla shares off just a touch, but this yesterday after they gained 10% on the heels of a recommendation by Morgan Stanley analysts to buy the stock, that it was undervalued because of some of its newer technology. And then Apple, Tom, ahead of what we're going to hear later today, shares up 0.4%. I think it's important to stress when we're talking about incremental moves in some of these stocks, the market cap of these trillion-dollar behemoths really points to why we care. This is a significant part of the market. It's a significant part of the economic optimism that we've been hearing throughout the year. And it shows how little disappointments or little upside surprises can make massive swings in the share price.
Well, they do there. And again, the growth rate is all, and it's the revenue rate. And we need to make the distinction here before we get to Ed between Microsoft with growing double-digit revenues and Apple's not. I think a lot of people don't understand Apple's not delivering double-digit revenue growth.
That's not why the same, right?
This soiree today is important. Is that it? Are you done with your, fanboy market movers?
Going, but let's leave it there.
We'll leave it right there. Joining us on, this is really cool. Ed Ludlow with Bloomberg Technology. We bust his chops. He's not a fanboy. He's technologically a look at anything, including he knows how to pronounce Huawei, and I don't. But behind him, for those of you on radio, it looks like an ice rink, but it's not. It is the architecture of Foster and Partners, and it is a Steve Jobs Theater in the beautiful new Apple campus that they have out in Cupertino. In what way, Ed Ludlow, will Mr. Jobs be at this soiree this afternoon?
Because it's a pivotal moment for Apple to kind of prove that Cupertino knows what it's doing, right? Lisa makes the point that from a market or weightings perspective, Apple's really key, right? 7% weighting of the S&P 500. But they're also at the center of all of the headline and political risk that's going on with China. You are exactly right, Tom, that this is not a company growing at double digits. They've had 3 consecutive quarters of overall sales decline. But in the June quarter, it was a record for China. And that puts the iPhone firmly in focus, because in China, in the June quarter, Apple swung to an 8% top-line gain from a negative 3% year-on-year gain the prior quarter. And what Tim Cook said, it was all iPhone. So then how do you balance the action by the Chinese government to clamp down in the public sector on use of iPhone, with Apple hoping that the upgrades of the iPhone 15 generation coming today is what's going to spur growth in that key market?
Steve Jobs, Ed Ludlow, don't let the noise of others' opinions drown out your own inner voice. Apple has been steely. Rumors of Disney and all this and all the other fanboy garbage that you and Caroline Hyde cover every day. What is the inner voice of Tim Cook right now?
The iPhone is everything. It's 50% of sales, more than $200 billion last year. And the criticism that they face is on the strategy of reserving the key technological updates for the higher end. So what we expect today is 4 variants of the iPhone 15, a base model, a 15 Plus, but then a Pro and Pro Max. And the strategy from them has been to say, we're going to keep our key upgrades to the higher end, raise ASPs, average selling price, and hope that that resonates in key markets if volume growth's not there. We know volume growth's not there. The smartphone market globally has had multiple quarters of decline, particularly here in the US. But one data point I point to, it does matter whether people buy the higher end phone. But while the overall market has retrenched in recent quarters, look at the market share data. Apple has been able to continue to grow its market share, even though the overall market's declined. And they're hoping that those higher end technological updates today, which include a higher end processor, the A17, titanium edges as opposed to stainless steel, and advanced camera technology, that will be tempting enough for consumers in a difficult market in China, but also here in North America as well.
Earlier in the show, Tom was talking about one more thing, and he was joking about this. And typically, this has been sort of how they're remembered.
Ed's got a tattoo of that on his
one more
left
thing.
arm.
It has always been the main thing. One more thing, the exciting thing that people are going to cling on to. How much of a one more thing is baked into some of the expectations for today's event?
Well, full credit to Bloomberg's Mark Gurman. You know, we know a lot of what's coming today due to his reporting. I think you guys talked earlier a bit about the charging cord wars. This is not the one more thing, but it is the thing that people will talk about, the USB-C, because it was mandated by the European Union. And it will be interesting to see to what extent Apple kind of claim it of a move made on their own volition or by their own volition, right? But it will settle debates across households globally. You know, there is no greater pain or challenge to the global consumer or electronics enthusiast than the endless search of one's home to find a matching cable. And that may be settled today.
Well, okay, but that's not that exciting for people. Yes, it's exciting when it comes to settling some of the wars that happen frequently, but that's not exactly going to revolutionize the concept of Apple. How much do you expect them to start talking about artificial intelligence more materially after being so quiet in the hottest field of 2023?
I heard you talking to Mandeep Singh about this 24 hours ago. You know, Tim Cook and co have shown absolute restraint in talking about specific generative AI tools. You know, the line from Apple has always been that they have a long-standing competence in machine learning and AI. It is present in their software offering. All I can say is that will be a part of today's presentation, we understand, a later generation of iOS, but I expect them to show the same restraint about talking about AI.
Ed, one final question, because I know you got to get to the merch setup to get your Apple merch for this afternoon. The great surveillance to made of our guests is will telephone merch for this afternoon. The great surveillance to made of our guests is will telephone, T-Mobile, and Verizon come to the rescue. Do you just presume with all your, you know, I'm serious now, with your serious reporting, are they going to do it again and competitively basically buy people's fancy iPhones?
Big part of the strategy here in North America. Go back and look at the questions on the earnings transcript about the support that Apple is expecting from the carriers. It involves heavily incentivizing the consumer because, again, we discussed it already. The strategy from Apple is to reserve the tech updates for expensive higher-end products. The carriers have to come in and offer packages in order to make it more accessible to a broader market. And how much pain they're willing to take to drive volume is at the discretion of those carriers.
No.
It's a fantastic question, and it's one that Cook gets asked about on the call often.
It's going to be fascinating today. We bust his chops about being a fanboy, but between Mark Gurman and Ed Ludlow, it is world class here at Bloomberg. Look to Bloomberg Technology this afternoon for our complete coverage of what fanboy is. Caroline Hyde fangirl? I don't even know.
I will not call them that.
Okay, I will.
I'm sure you will. I'll push back.
The fan duet will be with you with complete coverage of the silliness out in Cupertino, but it is a huge impact. I like somebody said today, maybe it's Lindsay Piegza, it's not a discretionary item anymore.
Yeah, exactly.
You know, it's a staple. I guess that would be the right economic phrase.
But an iPhone 15 isn't a staple. Maybe an iPhone 8 for a kid. I'm just saying, if anyone's listening in the household.
They're not listening, trust me.
I know. No, I will say, though, that the idea of ending the cord wars would be a very nice thing, and not having to search for all of the little attachments and the right cord for the right thing.
The little attachment thingy always breaks. That's always the first thing to break.
Exactly, or something gets in it.
I agree with you. You know, I guess it's a nuance, and we don't like the Europeans to tell us what to do, except Francine Lacroix. But the answer is, I agree with you that if we just get to a more streamlined USB, it's USB-C cord. They named it after a Swiss bank. They named the cord after a Swiss bank. That's your input from Bloomberg Surveillance this morning. This market's terrible. We're going south.
Oh my goodness.
After Apple this afternoon, James Chanos will join, legitimate world-class short guy. This is Bloomberg. Stay with us.
Leadership is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from New York City this morning. Good morning, good morning. Equities just a little bit softer. We're negative here by 1/3 on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Apple set to unveil its latest iPhone, United Auto Workers softening pay demands, and ARM's IPO is 10 times oversubscribed. We begin with the big issue, CPI, up next.
We're going to have the CPI data. CPI data.
It's the CPI print.
CPI is important.
It's going to be in line with market expectations.
The headline is expected to be fairly high.
We do expect the CPI to come in strong.
Driven by energy prices moving higher.
Energy prices have ticked up.
We'll see what happens with the core.
We're going to get a continuation of the positive trends.
It's going to be very important if core CPI actually increases.
That will be more problematic.
The continuation of the drop feels the most likely scenario.
What does the Fed do with that?
I don't think the Fed's really going to change the trajectory in terms of September.
The question will become the November meeting.
They're either on pause or they've got one more hike.
This is a very complicated time for the Fed.
The last mile is going to be hard.
Joining us now to discuss Morgan Stanley's Vishy Drupator, Cameron Dawson of New Edge Wealth. Cameron, to you first. What are you looking for in that CPI report tomorrow?
Yeah, I mean, what consensus has priced in is a continued sort of moderation in the core CPI, a third month in a row of it being just 0.2% on a month-over-month basis. The real eye popper is going to be the headline CPI, of course, driven by higher energy prices. And then it's a question of how the Fed interprets that, or at least what kind of degrees of freedom that gives the Fed to be able to back off on their policy tightening. Because in a world where headline CPI CPI is accelerating, even if core stays flat, we're not sure if that really gives them the wiggle room to talk very dovish. At the end of the day, we've had a great deal of disinflation driven by lower energy prices. We can see that in non-durable goods inflation, which has gone from 13% to deflation back in June, but now that's starting to climb higher. So I think it presents an interesting predicament for the Fed going forward.
Particularly with crude close to 92, 91.80 on Brent, WTI just short of 89. Vishy, let's build on that. How do markets respond to what Cameron was talking about? Those two stories, headline CPI, driven potentially by gas prices, and core CPI, potentially showing some progress.
I think a lot will depend on the details. I think we do expect, I think Cameron, I agree with her, the core CPI will continue the progress of the last few months. Our expectation is 0.18% month over month for the August core CPI, and I think the deflation story in core goods will continue to be there. The acceleration in higher gasoline prices will mean month over month 0.61% is our expectation. I think this presents a challenging environment for the Fed for sure, but we think that there is nothing. We don't expect to see anything that will change the outcome of the September meeting, where we expect no hike from the Fed. And in our mind, Fed is done the hiking, and we think that's it'll be tough. The challenging thing would be messaging out of this would be a bit more challenging, but we think that the Fed has done enough to get their core inflation target heading towards their objective.
So, Vishy, you don't think the commodity market changes that? This is the note from Marko Kolanovic over at JP Morgan in the past 24 hours. This is what he had to say. The potential for the commodity price surge to feed inflation and extend central banks' hiking cycles. Would you disregard that?
Our view is that the Fed has done enough to bring down. Remember, their target levels are in core PCE terms, and I think they have done enough to get them down, and they'll be pleased with the trajectory of it. We don't expect that they will do a victory lap, but their language will suggest that they want to be long all optionality associated with it. But we think that's this is one of the reasons why we are constructive on duration, John.
How constructive? What are you looking for in a 10-year? I've got 350 over at Morgan Stanley with Matt Hornback, your colleague. I'm hearing 350 from Mike Schumacher. Bob Michael earlier on this morning was pretty bullish as well on fixed income. What are you looking for, Vishy?
I think we are end of the year at 365. We've just revised our numbers up from when you had Matt on your show from 350 to 365, but still that's a pretty meaningful meaningfully lower yields by the year end. We think the narrative will shift from slowing economy, and I think the market has been excessively, in our minds, focused on this immaculate re-acceleration of growth narrative, which we don't buy into that narrative. I think the market will come to recognize that the economy will slow. There will be give up in consumption, and we will slow in the fourth quarter, and we won't expect to see an explosion of supply, anything outside of what's already in price. So all of that we think will contribute to lower yields to the end of the year.
Cameron, what are your thoughts on that re-acceleration argument?
I think that for now, there's really not much reason to doubt it, meaning that we continue to see data come in better than expected. And we haven't seen signs enough yet that you're seeing enough weakness in real data. If we're even thinking about the labor market, for example, we're still seeing initial jobless claims, continuing claims remain very well contained in that tight territory. There are signs that things are easing around the surface, things like job openings or quits ratios, but those aren't signs enough yet to say that the economy or the labor market is falling off a cliff. So as it translates to the bond market, we think the bond bulls will eventually be right, meaning you will eventually see lower yields, but the timing is important, meaning that the strong economic data just effectively puts a floor under yields and likely pushes out the ability to reach those lower yields until we see signs of actual economic weakness.
2-year this morning back through 5%, up a couple of basis points so far this morning on the 10-year. On the 10-year maturity, down about a basis point to 428. Mike McKee, that data fewer than 24 hours away.
Yes, indeed. And don't forget retail sales on Thursday if you're looking for that re-acceleration story. The question is, as Cameron put it, what is the Fed going to make of all this? We do get a role reversal in the forecast for CPI with the headline expected to go back up again, energy prices to blame, and the core continuing to fall. Now, the core is what the Fed is going to be watching, so that'll be the important number. And tomorrow after CPI and Thursday after retail sales, we'll all be looking at this line. This is the Fed forecast. What do the markets think the Fed is going to do in November? As you can see, it's been very flat. People not expecting an increase, maybe about a 38% chance at this point for November, since September's sort of baked in as a no-move situation. So that's going to be the thing to watch. And then, of course, that's going to be influenced a lot by what happens at the Fed meeting. I'll leave you with this. Some people are thinking we're going to see a bit of a rise in services because the Taylor Swift and Beyonce concerts ended in August with a number of shows, and this is admissions prices and hotels. Now, hotels haven't gone up despite all the talk in the Fed Beige Book. We did see admission prices rise. The question is, did they continue rising through the month because the concerts came to an end, and does that mean we're going to see a big drop in September?
Thank you for that, Mike. Vishy can't wait to talk about this. Vishy, I actually know the team at Morgan Stanley's written about it. Are we modeling the US consumer off the fading bounce from Beyonce and Taylor Swift?
I think it's Beyonce, Taylor Swift, Barbenheimer. The combination of all those things have led to what I would consider to be a one-off extraordinary spending on entertainment. Remember, these are very small categories. For these small categories to have had such a major impact on consumption spending, it has to be really big. And it turns out that it has been really big. So this is an unusually a strong entertainment spending, and that extraordinary spending we think is a one-off, and we will come back to normalcy in the fourth quarter. So we do expect to see that consumption, pull back, and that sets the tone for slowing of the aggregate economy into 2024.
Cameron, it's almost hard to believe. Are we really saying that boom in discretionary spending this summer was down to a couple of movies and a few music concerts?
It's hard to think. I mean, I didn't go to any of them, but I think at the end of the day, the consumer has had the tailwind of being able to spend down excess savings at the same time that real wage growth did turn positive, meaning that as inflation moderated, people were getting more purchasing power, and that helped boost spending at the same time that you're seeing usage of credit cards go up. So that all has been a tailwind for the consumer all through the summer. And it's a question then of, does that turn in the opposite direction? We know that the excess savings have been whittled down. We know we have now the headwind of the return of student loan payments. And then it's a question about real wage growth. And if we see this reacceleration in inflation, do we get this golden period of real wage growth now turning back negative as we see things like oil, gasoline prices move higher? And that could effectively be the pinch that causes the consumer to slow down now that they're dealing with all these headwinds. It still remains to be seen, though.
Cameron Dawson sticking with us alongside Vishy Tripator. Your equity market going into the opening bell about 20 minutes away. Equity futures near session lows. We're down here by 1/3 of 1%. Let's get you some movers going into the open Here's Abby.
Hey, John. Well, we do, of course, have some stocks that are weighing on the futures this morning on that lighter tone that you're talking about. Oracle being one of them, in fact, down at this point, down 9.4%. I think this is going to prove to be the worst day since March of 2020. This, of course, is the infrastructure software company's cloud sales fall short. The growth slowed to 64% year over year, which is shy of the estimate of 67%. So folks really wanting high growth. RTX Corp, the aerospace and defense company, they lowered their full year outlook on the impact of the Pratt & Whitney powder metal manufacturing issues. As a result, some banks downgraded the stock, including Barclays and RBC. And then UPS down 1.5%. They are saying that the first year of their recently struck labor deal, well, it will be the most painful for them, front-end loaded, and we have many banks on the street cutting their price targets on the shares of UPS as a result, John.
Abby, thank you for that. Coming up on this program, Apple announcing its latest product lineup.
What continues to come out of Cupertino is the gold standard. This is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
We'll head to Cupertino, California, up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
They've gained a net incremental 125 million users over the last 2 years. 250 million iPhones have not been upgraded in 4+ years. And if you look at this special chip camera technology and what continues to come out of Cupertino is the gold standard. And that's why I believe, especially with a lot of big carrier discounts, this is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
Dan Ives of Wedbush doing what he does best, making a bull case for Apple, the company kicking off its Wanderlust event at 1 p.m. Eastern in Cupertino, and widely expected to unveil their latest iPhone, smartwatch, and AirPods. This coming amid simmering concerns in China as authorities move to ban iPhone use amongst government officials. The region's still a critical market for Apple. Bloomberg's Ed Ludlow joins us now with more. Morning, Ed.
Yeah, good morning, Jonathan. 4 variants of the iPhone 15 is what to watch for at the base end, an iPhone 15 and iPhone 15 Plus. But as you know, the strategy from Apple has been to reserve the higher extent of technology upgrades for the higher price models drive up those ASPs. iPhone 15 Pro and iPhone 15 Pro Max expected to have the latest generation of Apple's proprietary A17 processor, aesthetically having titanium sides as opposed to stainless steel. Sources tell us that that makes for a lighter weight but also more durable handset. And then there's the USB-C upgrade. This is not something Apple has done of its own volition, but something mandated by the European Union to revert to USB-C charger connector as opposed to the Lightning connector introduced in 2012. A key Bloomberg report overnight, John, which touches on the China story you referenced. Bloomberg reporting that iPhone 15 will be the first generation where Apple ships a built-in-India phone from launch. Historically, what they've done is ship built-in China handsets, and then with a latency of 6 to 9 months, started building that generation via Foxconn in India. According to our sources, straight from the get-go in key markets like India and other parts of Southeast Asia, they will ship built-in India handsets straight away, which talks a lot to what we've discussed in the last week, you and I, about the supply chain, but also political tensions between the United States and China.
Big time, Ed. This is not just about the CEO, Tim Cook, it's about the diplomat, Tim Cook. And Ed, I want to talk about that. This is our reporting.
Yeah.
Do you think this is something he avoids or even touches on a little bit later?
Yeah, what I would say, Jonathan, is keeping in line with the precedent set in the pandemic era, this presentation will be pre-recorded and shown as a video, even though it's displayed here on site at the Steve Jobs Theatre in Cupertino. That event at 1 p.m. Eastern Time, 10 a.m. local. So there isn't sort of this opportunity to put questions to him. Of course, there is intense interest and a lot of reporting from Bloomberg about the movement of supply chain from its high concentration in China to India, but that is a long-term thing. I just remind the audience of what you and I discussed over the last 7 days. China is still a key market. The June quarter was a record, and it was principally switchers in China. Those consumers switching to iPhone for the first time or from another model that drove that 8% top-line gain, a swing from a 3% year-on-year decline in the prior quarter. Key market from a sales perspective, but a supply chain perspective as well.
Ed, thank you, sir. Looking forward to your coverage with Caroline Hyde a little bit later on this afternoon on the iPhone launch from Apple. Love this quote. Jim Reed, Deutsche Bank, had this to say this morning. Welcome to my annual day of being seduced into buying a new iPhone that I don't really need but desperately want. Apple launches their new product suite today, which actually is a potential macro mover. Cameron, I'm coming to you on this one. How important is this event a little bit later this afternoon for this market?
I think if we're trying to extrapolate a macro read from this event, it's Apple's confidence about how much they can push price. Will they raise the price on this new iPhone? And can we read through that on the overall ability for prices to continue to rise to the consumer? We know consumer prices have risen materially since 2019, prior to the pandemic, by 20-30% in different categories. And so we're starting to see signs that some companies are having trouble pushing price even further. So is Apple confident that they can raise prices? And if they are, that might be a read to the consumer is stronger than maybe some people expect.
Cameron, to get the right signal from that, do you see the iPhone as a discretionary good or a staple?
I think that it's emerging into a very expensive staple. At the end of the day, people use the iPhone for a living, for their business, and so it's a can't live without, but it comes with a huge price tag.
It comes with a big multiple as well, given the growth that isn't there at the moment on that particular name. Vishy, let's put two stories together. Where bonds are priced right now, where rates are over at the Federal Reserve, and ultimately where multiples are for some of these growth names. Is there some conflict there, Vishy, in your mind?
In our mind, there is a conflict in terms of valuations and our look ahead into our constructive view on duration. We think that is this is from an asset allocation perspective. We think it's clearly a time to be overweight a range of fixed income assets, and our recommendation is being overweight fixed income, perhaps equal weight in equities in the global sense, but perhaps in equities we prefer rest of the world equities over U.S. equities. So that's how I would think about it.
Vishy, that international preference, can you just build on that a little bit more, given where Europe is, given where China is, what international?
So Japan is a big positive. India is a big positive from a equities perspective, from our reflecting the views of our equity strategists. I think in fixed income, there's a wide range of opportunities from mortgages, high quality credit. Not only, in fact, high quality credit, we would be even constructive on a double B credit, high end of the high yield credit as well. Will be constructive on that. The opportunity set to get to 6% of type of total returns without taking enormous amount of either duration risk or credit risk seems like a pretty attractive proposition today, given the valuations you're seeing in the equity market.
Squeezing in the credit story there, Cameron. Two issues there in the equity market that we just shared with Vishy. Let's go through them one by one. One, can these equity multiples live with higher for longer in the bond market that perhaps, Cameron, you anticipate? And two, the opportunities abroad, given the slowdown we're seeing across the screen week after week in China, in Europe.
Yeah, I think you have to be extraordinarily selective within international markets, focus on the companies with very high quality, good return on invested capital. These indices continue to be value traps in aggregate, meaning that they've been cheap versus the US for an extended period of time, really for 15 years, have been in relative downtrends. Those don't seem signs of turning, which just means selectivity is key. And then when we think about valuations from the perspective of higher for longer rates, we think that the ability for valuations to be the key or sole driver of upside to equity markets, as they have been since the October low, has kind of reached its zenith, meaning that you really can't push valuations much above 20 times forward earnings with the idea that the Fed is going to remain tight. It doesn't mean that valuations have to collapse. That usually would happen if you have growth fears emerging, so a bit of a different scenario, but it's likely that you don't see that same kind of valuation upside being the driver of equity returns.
Stocks here near session lows with negative 0.4%. Cameron, thank you, alongside Vishy. Cameron Dawson, Vishy Tirupatur. Just want to share a statement with you from the White House on the President of the United States coming to New York City. The statement reads as follows: that President Biden will travel to New York to participate in the 78th session of the United Nations General Assembly on September 19th, 20th. In addition to addressing the General Assembly on the 19th, Biden will meet with world leaders as well. So that address coming from the President, just confirmation of that in a statement from the White House just moments ago. That address from the President, September 19th here in New York. Coming up in the morning calls and later, Chris Harvey of Wells Fargo on why he's bullish on the market's biggest stocks. That conversation is still ahead. Your opening bell is 7 minutes away.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
equities, stocks pulling back just a touch here, going into the opening bell about 5 minutes away. Stocks on the S&P, we're down here by about 1/3 of 1%. That's the price action. Let's get you some morning calls. First up, Wolf Research upgrading CVS to outperform $80 price target, seeing an attractive risk reward and more reasonable growth expectations. Next up, both Barclays and RBC Capital downgrading RTX after earnings, expecting limited upside after the defense company cut its annual sales forecast. And finally, D.A. Davidson trimming its Oracle price target to 105, slashing estimates after cloud sales fell short of what we expected. That stock is down by 10.7%. Coming up, go big or go home. Chris Harvey of Wells Fargo expecting the mega caps to outperform as we near the home stretch of 2023. Your opening bell just around the corner.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The NASDAQ reminding us how old we are. Harry Potter, 25 years ago. Unreal. Futures on the S&P 500. Futures negative here on the S&P, down by about 0.4%. On the NASDAQ 100, we're down about 0.5%. The main event for the NASDAQ later on today, the iPhone 15. There's your opening bounce, switch at the board and get to the bond market. The main event for the bond market, the broader market, really is tomorrow morning, 8:30 Eastern Time. CPI just around the corner, then on to retail sales, PPI and all that good stuff later in the week. The bond market looks like this. Yields lower by a single basis point, 427.62. In the equity market, we're doing our thing in foreign exchange. The dollar's been stronger than weaker, then stronger again today. Euro dollar 107.13, we're negative 1/3 of 1%. And to finish on commodities, new highs for the year on crude. Brent right now, 91.63. WTI, 88.50. Big story in the last month or so. 30 seconds into the session, we are down 1/3 on the S&P. On the Nasdaq, we're down about 0.4%. The stock to watch at the open is Oracle. Shares moving sharply lower after reporting slower growth in cloud sales. Chairman Larry Ellison touting the company's AI contracts, saying this: companies have signed contracts to purchase more than $4 billion of capacity, twice as much as we had booked at the end of Q4. Abby has more on this one. Abby, that stock down and down hard.
It is unbelievable to me, John. I am simply stunned. I rarely talk about technicals on this show, but this stock absolutely gapped down to its 100-day moving average. That's a fancy way of saying that the buyers just literally an air pocket. They just disappeared. The sellers stepped in, and it actually confirms the stock for a sub-100 decline. Whether or not that happens, we don't know. But that's how bad investors are taking this quarter. And it's interesting because when you read about it, it doesn't actually sound so horrible. And analysts to some degree are actually defending the company at the lows, down 11.7%, the worst day since March of 2002. Right now, stabilizing, down just 11%, the worst day since March of 2020. As for that quarter, there was actually lots of strength there. To your point, overall, the cloud grew 30%, not so dissimilar from Microsoft, Amazon, Google. There was a subset of the cloud growth that was 64%. Doesn't sound so shabby, but the estimate was for 67% growth. Many analysts are saying that high expectations, that's really the story. Valuation got ahead of itself. Valuation on the surface wasn't so high, 22 times forward, but from a historical perspective to where Oracle usually trades, it was super high. Plus, Monness Crespi did actually cut the stock to a neutral from a buy on that valuation. Also talking a little bit about how licensing and hardware came in a bit below expectations, but again, this stock just getting absolutely punished on the day, John, down 11.9%, and I believe, I'm just checking right now, that does make it the worst day, going all the way back to, it's cycling through lots of data right now, March of 2002.
The pandemic, I believe, back to 2020, potentially, if we sink here at 12%. We're down about 12% right now. Oracle at 111 in early trading. Abby mentioned that note from Brian White of Monness Crespi saying this: valuation has become less compelling, sentiment is overly optimistic, and we believe the darkest days of the downturn are still ahead of us. This is brutal stuff. We're lowering our estimates and downgrading our rating on Oracle to neutral from buy. The latest from Monness Crespi there. Sticking with tech, Apple unveiling the iPhone 15 at the company's biggest event of the year, along with updated versions of the smartwatch and AirPods as well. Ed Ludlow was more on the ground at Cupertino, where all the action takes place. Ed, that one coming up in a few hours' time.
Yeah, and the market's watching. Apple modestly higher, 0.3% at the open. The event, 1 p.m. Eastern, 10 a.m. local time. As we outlined earlier in the show, the big ticket items are 4 variants of a next generation iPhone 15. I say the market's watching. I'm going to leave you to debate with your guests in the hour about the macro implications of what happens with Apple. But from a pure weightings perspective, this is a stock that is 7% of the S&P 500. It is normally the biggest points mover in either direction on the Nasdaq 100. And based on past precedent, the bar is high. Go back to 2011, there have been 12 iPhone unveil events since 2011. Apple shares have only risen on 3 sessions corresponding to those events. So usually they fall, and it's a kind of sell the news type event. But the bigger picture for Apple is more bleak. We've had 3 consecutive quarters of overall sales decline, apart from in Greater China, where there was a swing to top-line growth of 8%. Based on the guidance given on the call for this current period, it looks as if we're on track for a 4th consecutive quarter of sales declines. The question, therefore, is are these technology and hardware upgrades on the iPhone and what we expect from next-generation Apple Watch and AirPods Pro with USB-C connector going to be substantive enough that they drive the consumer globally to do this upgrade cycle that Dan Ives has talked to you about? The estimates range from 150 to 250 million units out there of people that have older generation iPhone. Will they be tempted to upgrade? And the same question for China. Will the iPhone 15 be a hit in China on the higher end Pro and Pro Max at a time where China's central government is clamping down on foreign handset use within government agency and state-backed enterprise?
Dan's been talking about that upgrade cycle as a bullish thesis for a long time. I touched on it with him in the last week. And at some point, don't we just sit here and say, we need to ask a different question. Why aren't they upgrading?
Yeah, I guess that if you were to ask Mark Gurman, he would give you a pure technology answer, that the updates for generations of iPhone 14 and 13 were incremental. This time around, there is a heavy emphasis on the camera upgrade for the Pro and Pro Max, as well as the titanium sides, a higher quality material, lighter weight, more durable, sort of some Pro-specific software updates. Is that enough? We won't know, Jonathan, until after the fact. But this is being billed as one of the more substantive hardware upgrade cycles that Apple has done, or refreshes in some time.
Ed, thank you, mate. As always, that stock, marginally positive. About 5 or 6 minutes into the session, we're higher here by 0.1%. Want to stick with tech. Google's antitrust trial gets underway today as it faces a pair of lawsuits that could result in the breakup of the 25-year-old company. Simone Foxman, I'm not sure how many times I've had to read a headline like that in the last 15 years, but there's another one.
Yeah, you probably haven't had to read one this century because this is the biggest DOJ antitrust suit since Microsoft, certainly the biggest for Google. Now, this really has to deal with arrangements that Google struck with various smartphone manufacturers, with the likes of Apple even, to make Google's search engine the default. Apple likely to get drawn into this in particular because just in 2022, it had $18 billion worth of revenue from having Safari use Google Chrome as or Google Search as its default search engine. So what the DOJ alleges here is that these agreements have essentially forced out some of Google Search's rivals, the likes of DuckDuckGo, the likes of Bing. That is predatory behavior by the monopoly. Google Search controls 90% of the market. Google, however, says consumers are just one click away from other search engines, and that its deals with these companies are similar to the ones that cereal makers, for example, strike with major grocery stores. Now, this trial is expected to go on for about 10 weeks. We won't likely see a decision until next year, and that could be part of the reason that we're not seeing Google shares move too much outside of the market today, but the potential to break up the company, to move search away from things like Maps or Android, but the possibility that we could see, even if the DOJ wins, some smaller sorts of ramifications, John.
Simone, thank you. Thanks for the update there on Google, Alphabet, whatever we're calling it these days. I want to talk about ARM, planning to price its shares tomorrow, but it's closing its order book a day early, with it already being oversubscribed by 10 times. Mandeep Singh joins us now for more. Mandeep, is this how you build enthusiasm up against the listing? You just do things like this?
I think, look, I mean, it was expected that there will be a lot of interest from large companies. And in this case, you know, TSMC just announced a stake in ARM IPO, and we are hearing Apple and NVIDIA. And look, with ARM specifically, because it was a takeover target, you know, with NVIDIA trying to buy it at $40 billion, there's a sort of that floor on its valuation. So the fact that they priced the IPO around that 50 to 55 billion was a good sign, and I'm not surprised that it's oversubscribed at that valuation.
Mandeep, how much signal should we take from this in the broader equity market, given the uniqueness of this particular listing?
Look, I mean, the dominant theme this year is Gen AI, and it kind of built on cloud. And today we are talking about, you know, Apple launching a new smartphone. The core IP block that underpins all of the innovation is built around ARM. And even though they don't have the pricing power, which is the bear argument that, you know, ARM really relies on royalty revenue, and how often can they increase the pricing on that royalty revenue, the fact is no one wants to move away from that core IP that ARM has, and that's where I think they will have that IP for a very long time.
Mandeep, thank you, sir. A story, a conversation for us later on in the week. About 9 minutes into the session, pulling back by 0.2%. Chris Harvey of Wells Fargo making a bullish call on Uber Cabs, saying this: you're getting better growth, better balance sheet, stability with an AI kicker, what's not to like? Chris Harvey joins us now for more. Chris, I was reading through your research, and we'll get to the Uber Cabs in just a moment. This is what you had to say on Apple. You didn't have the iPhone ban on your bingo card. Well, Chris, it's on there now. Can you tell me how significant that is, that tension between the US and China, and what it might mean for some of these multinationals listed here in America?
Listen, anytime you have stress between the U.S. and China, it's going to play out in the capital market. It's not a positive thing, right? But I don't think it's the end of the day. Ultimately, what it does is causes volatility in the short term. It could create some quote-unquote opportunity but we're not focused too much on that. What we're really focused on is seasonality. We're focused on FOMC, and we're focused on inflation or tomorrow's CPI print.
Well, let's talk about tomorrow's CPI print. Cameron Dawson at New Edge was on the program with us about 35 minutes ago, Chris, and she talked about the difference between headline CPI, driven by energy prices and gas, that's going to be elevated, and core CPI, potentially showing more signs of progress. Do you discount one, ignore one, and just focus on the other?
I mean, the answer to that is always, it's the deviation away from expectations, right? If there's a massive deviation versus expectations, you have to take that into account. But really, it is true. You do want to focus on core. You want to see what core is doing, and you want to see more relief. The one thing I will say is that we've looked back over the last couple quarters and last couple months, and one of the things we've seen is that when you have real rates going higher, when you have credit spreads widening out in the month before the print, that's usually not a real positive sign. What you should expect, and what the market's beginning to tell you, is it may be more of an inline to a little bit hotter print, because with higher real rates and higher, or excuse me, wider IG spreads, that's not a real positive thing for inflation. That's telling you the market's reacting to something, and you might want to be a little bit careful going into the print.
So what should I do with $90 crude, Chris? What does that mean for my equity market? What does 91.84 on Brent, 88.68 mean on WTI?
Yeah, John, it's a great question. I had a long conversation with Roger Reed, who covers our energy space. And one of the things he said to me, which I think is true, we're going to be in an environment where it's higher for longer. The incentive to create more supply just isn't there. There's still this very adversarial relationship between the hydrocarbon space and the administration. And you're seeing rig counts come down. So what do you do with it? I think that the belief is that it is going to be higher for longer because of some of the supply-demand dynamics. China, funny thing is, China really hasn't come back online. That could really change the equation. And the last thing is, if that's true, if it's higher for longer, later on, or if some people, if I'm wrong and a lot of people are right, that there's going to be a strong recovery next year, then that probably brings the Fed back in because of that inflationary issue.
So, Chris, how does that compete with the original call? Embrace UberCap Tech?
Yeah. So the original call, so just on a sector basis, one of the sectors we loved coming into this year was media and entertainment. And you do have a lot of UberCap names in there. The reason why we liked it is it was a perfect, or what we thought was a perfect GARP type sector. A lot of growth stocks that had gotten beaten down, had been really bad performance last year, and we thought the fundamentals would turn. So it does fit in with the call. Ultimately, what we're telling people is, on a market cap basis, in the short term, it's UberCap. But if you're looking longer term, mid-cap growth is really a good risk reward longer term.
Chris Harvey of Wells Fargo. Chris, appreciate the update from you and the team, as always. Chris there on why it's bullish UberCap Tech, even with the prospect of rates remaining high for longer. Remember that note from Marko Kolanovic over at JP Morgan in the investment bank, trimming their duration overweight by shifting 1% from bonds to cash. This is the why. Given the potential for the commodity price surge to feed inflation and extend central banks' hiking cycles, which speaks to this move in crude, just short of $92 a barrel right now on Brent. We're higher by 1.5% on the session. On WTI, just about to go through 89, up by close to 1.8% today. Coming up, negotiations continue as the auto workers' strike looms.
Part of this move on the labor unions, I think, for the United Auto Workers is staying relevant and making sure that whatever changes occur in the economy, they still have a place.
The latest from Washington, D.C. with AMH, and the latest from Detroit with David Welch. Team coverage up next.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president is calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy, but man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This move on the labor unions, I think, for the United Auto Workers is staying relevant and making sure that whatever changes occur in the economy, they still have a place. Labor does have some more power now than it used to, just because the manufacturing is so much smaller now that the ones who are doing the manufacturing, if they do pull back, that is going to be an issue for those three companies. We're starting to see companies who have been able to charge more for the consumer, their workers are looking back and saying, hey, you guys are making record profits. We would really like a piece of this.
A deal between the United Auto Workers Union and Detroit's Big Three remains elusive just 2 days before the strike deadline. The UAW lowering its pay increase demand to 36% from 40%. But according to our reporting, the automakers not thinking much of the offer, seeing the demand as boosting labor costs so high that it would threaten their viability. Even a brief UAW strike would cause billions in economic damage. Anderson Economic Group finding that a 10-day work stoppage would reduce US GDP by $5.6 billion. Let's get to the team coverage. Bloomberg's Anne-Marie in DC, David Welch in Detroit. David, first to you. What's on the table? Where is their movement? And what are the chances we get a strike at the end of this week?
The big issues all along remain. It's pay raises, cost of living to protect workers from inflation, and they want to bring back pensions. They've talked about other things like a shorter work week and that sort of thing. I don't think those are really the big issues. It's all about pay, inflation protection, and possibly bringing pensions back. We've seen movement on pay. The UAW went from 40% down to 36%. The companies don't think much of it, but at least it's some movement. I think if the union is serious about pensions, we could have a long strike. If that was sort of a low ball or high ball offer, as the case may be, and they're willing to maybe just get better 401k contributions or something like that rather than a guaranteed pension, then maybe we don't have a long strike. That could be a big defining issue, though, because I think the companies will also move on COLA because that's cost of living allowance. Ford made an offer on that the union didn't like, but you're starting to see the two sides bend a little bit on this whole pay issue.
David, what number do you think gets it done? Based on your reporting, do we have any idea? You've got the union at 36. I've seen offers close to 10% on the table. What gets it done?
I think if you take all the different ways of giving these workers a raise, somewhere around 20% over the 4 years could probably get this done. That's the best raise I've seen for union workers since I've been covering this, and it's higher than the automakers have proposed so far significantly. So somewhere around there, give or take, could maybe get it done.
AMH, we can picture a president nervously waiting in the White House, wondering what on earth he'll do if this strike actually takes place.
Well, that's exactly right, Jonathan, because what you see is really two competing aims of the Biden administration at play here. President Biden says time and time again he wants to be the most pro-labor union president. At the same time, he wants to be a climate president. And at the crux and at the anxiety, a lot of these issues for the UAW workers is the auto industry's move to electric vehicles. Just a month ago, the president put out a statement. Obviously, he was concerned. He talked about wanting the big three to make sure that UAW workers have living good wages to support a family and community. He also talked about the need for a just transition to EVs, and so that those workers should be the first to give a shot at working at an EV plant. Also, Jonathan, the end of the month, we saw the administration give more than $15 billion in funding and in loans to auto companies for the factories to retrofit to EVs. So this isn't starting new plants, say a battery joint venture in the South, but actually using those same factories. So you see the president trying to do two things at once: support the UAW workers, but at the same time support a transition, which may mean you're not going to need as many of those workers.
A transition away from this, $92 Brent, $89 WTI. AMH, while you're here, let's finish on that. What does that mean for this White House, this country?
Well, it's very difficult, obviously, because we remember last summer how painful it was for this administration when they were dealing with $5 a gallon gasoline at the same time that we have seen inflation across the board go up, whether it's not just gasoline, but whether it's rent or whether it's groceries. So much so that this was painful to the administration that the president, who once called a pariah the crown prince of Saudi Arabia, Mohammed bin Salman, he actually went to Saudi, and obviously we all saw that meeting and the fist bump that pursued. You have now a gallon of gas inching nationally towards $4 a gallon. This is very concerning for an administration because the president continues to get low approval marks across the board, but especially on the economy.
We're going to say inflation's coming down, and then we're going to look at 384 on gas. AMH, thank you. Anne-Marie, alongside David Welch. Your broader equity market at the moment, 22 minutes into the session, pulling back by just about 0.25% on the S&P 500, on the NASDAQ down by about 0.1, with some sector price action. Here's Abby.
It's interesting, John, because that's a relatively small decline, and yet we have most S&P 500s trading lower, so it's a broad-based decline, and specifically 9 of the 11 sectors are down. 2 higher, energy not surprising, leading the way up 1.4%, being boosted by that high price of oil you were just talking about. To the downside, healthcare, real estate, and tech, those are the worst, down more than 0.5%, but no big declines. So as you would say, not a lot of drama here. Where we do have some interesting trading action on the month, though, is September right now is shaping up to be an okay month for the S&P 500. The top sector right now is consumer discretionary, led by Tesla and Amazon.
Abby, thank you. Your trading diary up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem. I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Coming up to 26 minutes into the session, almost 26 minutes into the session, we're down here by 0.2%. That's the price action coming up through the day and through the rest of this week. Apple's Wanderlust event kicking off at 1 p.m. Eastern Time. Wednesday, we'll get US CPI. Thursday, initial jobless claims, US retail sales, and an ECB rate decision, plus the UAW strike deadline. And on Friday, China eco data, including property prices and industrial production. That's your week ahead. Kicks off with Apple a little bit later this afternoon, and then on to tomorrow morning. The main event is CPI in America. We'll have full coverage of that for you from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. Matt Miller, Paul Sweeney with you here. Coming up, we're going to get the latest on the auto industry and this potential UAW strike. We're going to do that with Joel Levington. He's the Director of Research at Bloomberg Intelligence. He covers the auto industry from the credit side. Then we're going to check in with Monica Defend, head of Amundi Institute, the largest asset manager in Europe. She's going to call up and talk to us about stagflation in Europe and what the investment opportunities there are in Europe. So all that's coming up in the next hour. But first, let's kick things off and get a sense of where these markets are with Karen Moscow.
Yeah, Paul, well, stocks, they are falling today. We're also watching the dollar rebound as traders await a key inflation report. It's going to bring more insights onto the outlook for Federal Reserve policy. That report is due out tomorrow. Tech, though, today weighing with Oracle sinking. We're watching those shares. They're down almost 13% this morning, this after reporting a slowdown in cloud sales. We're also watching Apple. It's down about 0.6% before it unveils updated versions of its iPhone, smartwatch, and AirPods. Also, oil in focus. Global oil markets facing a supply shortfall of more than 3 million barrels a day next quarter as Saudi Arabia extends its production cuts. We're watching NYMEX crude. It's up 1.6%, up $1.39 at $88.70 a barrel. Brent up 1.33% at $91.83. And we do check the markets all day long here on Bloomberg. The S&P 500 is down 0.25% right now, down 10 points. It's at 44.77. The Dow Jones Industrial average down 0.2% or 65 points at 34,598. And the NASDAQ is down 0.2% or 21 points at 13,896. 10-year Treasury, little change, yield 4.29%. The yield on the 2-year, 5.01%. COMEX gold is down 0.8%. It's down $15.40 at $19.3180 an ounce. And the euro, 1.0716 against the dollar. The yen, 147.19. And mentioning Bitcoin, it's up 4.9%. It's at $26,300 right now. And that's a Bloomberg Business Flash. Paul and Matt.
All right, Karen Moscow, thank you so much. We appreciate it. Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com, click on search for Bloomberg Radio. Matt, the thing that jumps out at me today is oil. I mean, I got Brent crude at almost $92 a barrel. I mean, OPEC is talking a tough game, but they're backing it up, I guess.
Yeah, well, I mean, there's a shortfall of crude barrels. Global oil markets, according to Grant Smith, who writes for Bloomberg out of London, says more than 3 million barrels a day will be the shortfall over the next quarter. And that is probably the biggest deficit in more than a decade because of these production cuts, at least partly because of these production cuts that we've seen out of OPEC plus.
Yep, it's amazing. I'm looking at the gasoline, $3.83. I mean, so you're on a $4 a gallon watch for gasoline around here. That'll get people's attention. Haven't seen that in more than a year. So anyway, that's
don't worry. They'll open up the SPR when it gets there.
Just pump more shale.
Just wait till we get closer to the election.
Yes.
You know, then all of a sudden the permits will start coming out. They'll open up the SPR. Everything will get easier.
Exactly right. All right, let's look at these markets here. A little bit of red on the screen. Not much happening here. We got a lot of eco data coming up during the rest of this week. Let's check in with Emily Graffeo. She covers the markets for Bloomberg News, and she joins us live here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at?
Well, we'll stay with oil because Occidental Petroleum is up over 2% today. So there's some green on the screen, at least in that stock. Not only are we seeing that stock higher because of oil prices, but we also had an article from Bloomberg's Matt Day about Occidental, writing that Amazon is buying 250,000 metric tons of carbon removal services from Occidental Petroleum.
Don't know what that means, but it's good for Occidental, I guess.
Amazon, I guess, trying to capture carbon from the environment, offset, and probably get to net zero. Amazon wants to eliminate carbon emissions by 2040, so this is part of their plan, and I guess it's boosting
you know all these
Occidental
carbon
price.
pipeline sales we've been seeing over the last couple of months? So what they want to do is get carbon out of the environment and then push it down underground.
Really?
Yeah.
Just like leave it there?
Yeah, that's the idea, that it stays there and doesn't seep back up somehow. I don't know the mechanics of it, but it's, I mean, some people are optimistic about it. So.
Okay, all right. Good
Pull
for them.
carbon from the atmosphere, a process known as direct air capture.
Direct air capture, boom. Occidental Petroleum stock.
I mean, plants do that also, you know.
Right, where are the plant companies? What are those
Exactly,
doing today?
exactly. So speaking of the atmosphere, cloud revenue wasn't as strong as had been anticipated by Oracle. What's the story here? Because it did jump 30%.
Exactly, yeah. So Oracle, biggest intraday drop since 2020. That stock down almost 13% right now. And like you said, in the earnings report, the cloud revenue jumped 30% to $4.6 billion.
Sounds awesome.
Sounds pretty good, but the estimate was for a 54% jump in that quarter. So I think that's why we're seeing the stock down
Boy, these
so
are,
much.
I mean, I love these days. If you're a holder of Oracle,
right,
you just back up the truck on days like today because you're like, oh, come on. And we had Anurag Rana on who does this stuff for a living, and he said on a currency neutral basis, which is the way you got to look at this, their cloud business was up 64% year over year. The consensus was 67%. So I'm like, please, you're going to sell off 10, 11% on that. But the stock had been up 55% year to date before that. So, okay, I'll give you a little bit of a pullback, 2, 3, 4%. But these are the days when if you're a hedge fund and this is a core holding, your trader has leeway to trade around that position. I own the core position, and if you want to trade around it and try to make P&L on your own, you can do that. That trader's buying Oracle today.
Yeah.
That's how it works.
And revenue was in line with estimates.
Okay.
Profit was just a little bit under expectations by like 4 cents.
So basically the problem for them is, I guess, what, stronger dollar? That's what it tells me when you say on a currency neutral basis, they were up, 60, what do you say, 64%?
Yep.
And then on a straight basis, they were up only 30% because they have so many euro contracts or yuan contracts or yen contracts. And yeah, that makes sense.
And you can figure that out. You go to the PGEO function and you can click on by geography. And they get about 45% of their revenue outside the U.S., 55% in the U.S. So that's a global company. Anything else, Emily?
Well, I'm an ETF reporter as well.
Nice.
State Street, which is the third largest ETF issuer by assets, launched its first ETF in over a year today. It's a dividend-focused ETF.
Really?
Timing is a little interesting here because obviously investors have been getting that income from bonds right now, from money market funds, from T-bills. But State Street, I spoke to them and they're sticking with their guns that this is going to be a long-term hold to have dividend at the core of the portfolio.
So what do investors doing? Like if I want to just buy the market, the QQQs, I mean, do I just look at the QQQ funds to see if people are coming into the market and then leaving the market?
It's a little loud, I think, with QQQ because that's such a trading vehicle.
Okay.
But we did also see, I guess yesterday, investors adding $3.3 billion to QQQ, which is the NASDAQ 100 ETF. That was
nuts.
The biggest one-day increase since March 20. So these flows are pretty noisy. We do see big inflows and outflows, but 3.3 billion, that's pretty significant.
In one trading session, and which is crazy because we're already what feels like so deep into this run, right? I think Eric Balchunas did the math and saw that over the last 5 years, 10 years, and 15-year periods, the Qs have beaten every single active fund manager in tech. So nobody can outperform this, simple ETF.
Yeah.
And everybody charges higher fees.
I don't get it.
Right. Just stay the course.
That's why I concluded, for what it's worth, in 1996, that the long-short equity game was played out. It was done. Not worth any investment. That's my call then.
At the same time, active ETFs have been so hot this year,
They
right?
have been.
That's true. Yeah.
By the way, the Qs has a 0.2% expense ratio.
So that's nice. All right, good stuff. Emily Grafeo, thank you so much for joining us. You're covering all the markets there. A little bit of red on the screen here today. All right, the big thing for me, I think, this week, I mean, there's a lot of eco data coming down, but are we going to have a strike in the auto industry? I mean, it kind of feels like it. And,
huge. And that could push, by the way, not only the state of Michigan into a recession, but if it goes on for a long time, it could be bad for the growth trajectory of the U.S. economy and for the inflation, underlying inflation numbers.
It's big, so hopefully they can get something done. Joe Levington joins us here. He's a director credit research for Bloomberg Intelligence. In his day job, he covers kind of the industrial companies, including the auto companies. Joins us here in our Bloomberg Interactive Broker studio. So, Joe, what's your sense here? You know these companies for a long time. Does this feel like they're going to go on strike? The union will go on strike Thursday at midnight?
Yeah, no, definitely, Paul. It does feel like a strike is coming. You know, even when you see Bloomberg reporting that the UAW has offered some concessions, going from 40% growth to 36% growth is still a huge difference between the 14.5% that the auto companies seem to be giving.
So let's get the hard numbers behind that. This is what they want in terms of an increase for salary and benefits, right, Joel? So what does it boil down to in terms of the cost for the automakers to get an hour of work from a union member?
Yeah, no, you're totally right. The way that I've looked at it is really in terms of EBIT for 2024, in terms of profitability. In the best case scenario at 20%, you'd have something like Stellantis being about 2% impacted. So really not that much before you consider some of the things that they could do. For Ford, which has a bigger unionized auto group, it could be as much as 10% of 2024 EBIT. Now, I do think there are ways that they can offset it. And going to your point about inflation, price is the number one tool that they have to use is to increase prices and pass it on to consumers. Of course, that leads to different challenges and different
which
winners
they've
and
also
losers.
done numerous times over the past couple of years.
That's exactly right. When
I priced my Dodge Challenger RT Scat Pack wide body,
which has still not been delivered.
Which still has not been delivered. And I hear, by the way, from inside the company, they're like, yeah, you know what? I think it's going to be delivered September 15th. And now that's just 3 days away, and I've gotten bupkissed in terms of... Anyway, the bottom line is when I ordered it in, a year ago, the price has already been increased like 2 or 3 times. And I'm wondering, do I have to then pay that price when they finally deliver it?
I don't know how that works.
No, in fact, you don't have to pay that price, but that's where some of the EV companies are getting hit materially, like a Rivian or a Lucid, which made deals 2 or 3 years ago, and now they're, offering these cars up at 30% less than what the price is today, and they're taking that loss in gross profit and really killing their liquidity. So, to your point, you won't have to get hit with that, Matt, but you did have to wait, and that's...
I bet you the dealer's going to try. I'll bet the dealer tries.
But you're a savvy auto guy. You're not.
Well, now because Joel told me that,
Yeah. Well, I would say
I have documentation from the day I ordered.
I know the owner of Stellantis, the CEO of Stellantis. All right, so
it doesn't help. The dealer does not care.
It doesn't care. Okay.
I've interviewed Carlos Tavares. That doesn't help me when I go into the dealership.
All right, so Joel, if you're these big auto companies, you don't want to go on strike, but you feel like you can't pay a 30 or 40% increase in. So where do you think this shakes out? I mean...
Yeah, I think you probably get to a midpoint of maybe about 25% over 4 years. Now, the offsets to that is, if you increase pricing 1%, that takes a huge chunk of that increase away. And then you start thinking about costs and where you can do that. One of the things that I always think about is bringing in products that you have gotten from suppliers, so insourcing some componentry. If you do that, that means you might be saving money. That might be a pressure point for a lot of the auto suppliers and how they're going to get hit. Obviously, if you're going for pricing, that's a positive for the dealers and what that means for them.
Well, if they can move the metal, because consider that these increases are only going to hit GM, Ford, and Stellantis. So if you're cross-shopping, say, the newest GM electric vehicle and a Tesla, and Tesla has to pay its employees like a third of what GM pays their employees, you're going to find a better price over at Elon Musk's company.
I think you're totally right, Matt. I wrote about this a couple of weeks ago, how Tesla might actually be the biggest winner. Now, I'm sure folks in Tesla's plants see a, let's say, 25% increase, and they're going to be asking for something too. But my guess is it's incremental or modest relative to what the UAW is going to get. So on a relative basis, Tesla is going to win on that. And as you've seen what they've done this year, is they've used that price to cut their prices or take a relative price cut and draw demand off of it, which I think means that Tesla will be, like the eventual winner out of this game with the auto companies.
And the others who produce here that don't have union labor, right? Which is like a ton of Asian and European automakers.
So like the BMW plants in Tennessee or wherever they put them?
South Carolina.
Are they not unionized?
They're not. And so, there is going to be a relative trade here in terms of how much you can go. And it's one of the reasons why the auto companies are pushing back so hard, because they play in a global market space.
I don't know. So, all right, from the...
You got to decide as a worker, Paul. Do you want to live in Spartanburg? Do you want to live in Austin? Do you want to live in Motown?
Probably Spartanburg's looking pretty good to me. All right, so from the balance sheet perspective, Joel, do any of these Ford, GM, Stellantis, do they have a balance sheet that you're nervous about? Should a long strike take place?
Well, the thing that I look at the most, and this is really a Ford and GM issue more than a Stellantis issue, is that the way that they get paid is that they get paid when they sell the car to the dealer, right? But they don't pay their suppliers until your typical 45 or 60 days afterwards. What that means is that they have a huge amount of payables that are lined up and very little receivables. When you have a stoppage of work, there's no receivable money coming in, but there's a huge amount of payables to the tune of maybe like $5 billion a quarter. So you have to have massive amounts of liquidity to handle kind of such a situation, which is really what Ford and GM have. I think Ford has something like $50 billion of liquidity available. GM has about $45 billion of liquidity available. So they can handle a near-term impact, but it has a huge view in terms of free cash flow for a year, in terms of the liquidity on their balance sheet.
They got a lot of leverage here. I'm looking at GM. I mean, they got a debt to EBITDA. I mean, there's a lot there.
There is, but keep in mind that includes the finance company. When you strip that out, if the leverage at GM and Ford is actually relatively modest, maybe more like 1 to 1.5 turns.
Okay.
It's really that they have finance companies, which is kind of hard to see sometimes, just because it's blended all together under their primary.
Now, I will say, everyone we talked to we talked to Seth Harris yesterday at Northeastern, who used to be an advisor to President Biden and Deputy Director of the White House's National Economic Council, and Claudia Sahm, she of the Sahm rule. They all say, look, the union took bad deals for the workers at the end of the financial crisis, and the car makers have raked it in since then. Surely they've been setting aside billions because they knew these negotiations were coming, right?
Surely.
But you're right. I mean, they got a certain deal with certain pay increases, and then this inflation came along, which nobody saw. And then, boom, now they feel like they need to get it back. It's going to be interesting. It feels contentious. Hopefully they can get something done by midnight Thursday night.
Especially if they haven't produced my Challenger.
I know.
Yeah,
I mean,
because I need them to make that and send it here.
That should be the priority of the negotiation.
The whole thing. We got to get that thing off the line. Joel Levington, he's Director of Credit Research for Bloomberg Intelligence, Senior Auto and Industrial Credit Analyst as well. So we appreciate getting some of his thoughts here. Again, big issues for the auto manufacturers coming up. Big labor, big auto. We've got strikes seemingly in a number of industries across this country. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. Apple's biggest event of the year is just a few hours away. The company expected to unveil its iPhone 15, along with updated versions of the smartwatch and AirPods. Bloomberg's Ed Ludlow is in Cupertino.
From a pure weightings perspective, this is a stock that is 7% of the S&P 500. It is normally the biggest points mover in either direction on the NASDAQ 100. And based on past precedent, the bar is high. Go back to 2011. There have been 12 iPhone unveil events since 2011. Apple shares have only risen on 3 sessions corresponding to those events.
Now, Apple shares right now down about 0.5%. And for the first time, the new iPhone model you buy on launch day could be made in India. Bloomberg's Alex Webb puts it into perspective.
The most recent data we have from March trailing 12-month revenue was about $6 billion in India. In China right now, Apple has in the order of Greater China, which also includes Taiwan, has in the order of $74 billion in revenue. So India has a long way to catch up. The iPhones that are going to be on sale made in India in the next generation, only a small portion of them will be coming from that market. The vast majority will still be made in China.
Now, to hear that full conversation, tune into the Bloomberg Daybreak podcast. And NVIDIA will join IBM and Salesforce at the White House today today, promising to adopt the administration's voluntary safety principles on artificial intelligence. Several companies, including Amazon, Meta Platforms, and Microsoft, have already taken that pledge. Shares of NVIDIA right now up almost 1%, shares of IBM down 1%, Salesforce shares down a fraction. Those are the company stories we're following this hour. We'll have more in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm Karen Moscow, and stocks are lower this morning, and the dollar rebounding as traders await a key inflation report due out tomorrow. That'll bring more insights on outlook for Federal Reserve policy. Ahead of that, though, we got a report moments ago that showed U.S. inflation-adjusted household income decreased 2.3% in 2022 from a year earlier, and that highlights the toll of higher cost of living, or of the higher cost of living for American families. While tech is weighing on stocks today, Oracle sinking. It's down about 13.4% after reporting a slowdown in cloud sales. It is the worst performer in the S&P 500 this morning, and we're also waiting the unveiling of Apple's new iPhone, smartwatch, and AirPods today. Apple shares are down 0.6% right now. And we check the markets all day long here on Bloomberg. The S&P 500 down 0.3%, down 13 points. It's at 4474. The Dow Jones Industrial Average down 0.25% or 81 points at 34,580, and the Nasdaq down 0.2% or 33 points at 13,884. 10-year Treasury down 1/32, yield 4.29%, and the yield on the 2-year 5.01%. We are watching oil and gas stocks. They are in focus. NYMEX crude oil is up almost 2% at $88.99 a barrel, up $1.70. Brent also higher, up 1.6% at $92.12. This is OPEC data showed global markets face a 3 million barrel a day shortfall next quarter. The S&P 500 energy index gaining as much as 1.7%. It was the top performing of 11 sectors in the broader market. COMEX gold is down 0.8%, down $15.40 at $19.3180 an ounce. The euro 1.0712 against the dollar. The yen 147.21. And we look at Bitcoin up 4.5% at $26,200. And that's a Bloomberg Business Flash. Paul and Matt.
All right, Karen Moscow, thank you so much. We appreciate it. Just looking at the, walking around Midtown Manhattan, Matt, I've said this for now months and months and months. The European tourists are back, baby. I mean, and you walk around Times Square, you just walk in the High Line, and they're just there, and it's awesome to see. What I haven't seen is the Asian tourists come back as much. So I guess the Chinese are still not able to go. But the Europeans are here, and we've seen millions of stories how the Americans took over Europe this summer, all the tourists. So I thought that the American tourists would support the European economy, but we got some
It does seem like we should be, right?
Apparently there's some bigger problems.
Literally everybody I know, except for you,
yeah, I was the only one who did not go to Europe,
has been to Europe in the last like 3 months.
Me and John Tucker.
Yeah.
Monica Tfen joins us. She's a head and chief strategist at Amundi Institute. That's Europe's largest asset manager. She joins us here in the Bloomberg Interactive Broker Studio. Love to have her in studio here. So, Monica, talk to us about kind of the European economy. I know we can't talk about it as in a whole because you have so many different countries, but my concern, I think my understanding is, if Germany's in trouble, Europe's in trouble. Talk to us about how you guys view the European economies.
Well, short term, we are really relying on Americans taking over during the summer. So probably we can have some lift on the quarterly GDP sequencing. But as you were rightly pointing out, on an aggregate, Euroland is not doing bad. If you look at the Commission, at the EU Commission projection released yesterday, there is no recession, but flattish growth. It is true that if you open the box, there are different countries within the same region, with Germany that is running into a recession for different reasons. It started with the manufacturing sector paying the toll of the industrial policy and of an economy centered on energy dependence, but now is moving into the service sector. Industrial production data were soft last week, but it goes without saying that if Germany is in trouble, this is going to be difficult for the entire region. Having said that, we have some other countries, France, for example, where we see the political willingness to continue to run fiscal support for the country, and France is an important economy. Spain, again, has been supported by subsidies on the energy sector, and this has been supporting consumption. It is going to fade away. And last but not least, Italy, where, again, the construction boom is over. So it is true that on aggregate, the situation is manageable. Probably at country level, there are several issues that needs to be tackled.
But not a super attractive place to invest, right? I mean, Germany's manufacturing sector is going to be hit hard by problems in China, failures there, and threats from companies like Tesla, who seem to be able to do Volkswagen's work far better. The French have luxury goods that, again, won't be purchased by rich Chinese people anytime soon. The Italians have democratic disaster, like a constant for the last, 50, 60, 70 years. And the Spanish are just supported by the rest of the continent. Plus, Britain shoots itself in the foot any chance it gets. I mean, where would you invest if you wanted to go to Europe?
Well, nice to see this from the American perspective. It's not that bad if you are a European. But having said that, first of all, in engaging the green transition at bottom-up level, there are some nice evidence. It is true that China slowdown is not is negative for the region, but we need to resize, starting from Germany, the dependence to China when it goes to trade and exportation, because a lot is done within the region, starting from Germany, which is an important take. If you ask me long term, probably as Europeans we should think more on an industrial on our industrial policy, but this is what we are discussing when it goes to healthcare, when it goes to pharma. It's going beyond the semiconductor story, and I think we are moving slowly, but we are active on that front.
So at Amundi, where are you guys in terms of your asset allocation these days, and maybe how it's changed over the last several years?
Well, it has been, given the macro uncertainty and the uncertainty on the monetary policy framework, it has been difficult really to pencil a medium to long-term strategy. We have been quite agile, for example, on the duration positioning, with a preference for a U.S. long and a EU neutral position. But again, it has been the time for agile, tactical, relative positioning. When it goes to the risk asset, we've been progressively reducing the exposure to credit, notably the high yield.
So reducing exposure to high yield credit. Does that suggest you guys are just generally more conservative on your economic outlook and interest rate policies?
It was also going into the U.S. high yield, I have to say. So it's really when you need to balance the risk return opportunity, probably repositioning on govies and equity on the traditional was for us more appealing. Equity-wise, while maintaining a cautious stance, we do like the U.S. value. And on the emerging market, we have been repositioning, moving to neutral into Chinese equity, but being more active in the emerging market region, notably Brazil, India, for example, Indonesia. So these are all countries that for different reasons are getting track.
But you are looking into U.S. value. Are you concerned that we do eventually have a recession here? The consumer's looking pretty stretched. We're going to get some data, I know, out on Thursday, retail spending, and it looks much worse than the last month's data we got. We're going to get inflation data out tomorrow that looks worse than last month's data that we got. Is the situation here getting worse?
So when it goes to the recession call, we do believe there will be a shallow recession. This will materialize likely in the first half of 2024 for the reason you were mentioning. The labor market is eventually cooling. Excess savings have been reducing remarkably over time, and probably also the fiscal, the Bidenomics and impulse to the investments, business investments won't be there for longer. When it goes to CPI and inflation, we think it is normalizing. It will normalize. It probably not in a linear way. Energy prices, recent prints on oil will have a positive contribution to headline, and the core will prove to be sticky. But as I was saying, overall, we expect this non-linear and volatile and probably less rapid than expected downward trend on inflation to continue. And this ends with a call that we are making on the Fed, where we expect them to hawkish pause.
Hawkish pause. I'm down with that. All right. So you spend half your time in Paris, half your time in Milan area. How was Lake Como this summer? I have yet to go to Lake Como, but it's on my bucket list.
Wait, you mean you've yet to go to Lake Como ever?
Ever. And I've been to Milan like a dozen times.
Why would you spend so much time in boring Milan and not
money.
Get up to Lake Como where
that's
things
where the
are
money
exciting?
is. That's where the money managers are. All right.
So I was in Chernobyl early in September, where we are having this think tank meeting, and the people out there were saying we have been taken over by Americans, and we do thank George Clooney.
I was going to say, as long as it's George Clooney, you must be happy to have us, you know?
Honestly, being an Italian, I don't know why you guys are going to the Lake of Como and not to the seaside in Sardinia or in Sicilia. Probably is the weather. Yep. But definitely there are a lot of tourists. We are really seeing this renaissance in Milan itself.
Nice. I love Milan. It's great.
I have to say,
but they're
all
taking down
Italy.
San Sirio.
I've spent time in Sicily. I've been in Bari. I've been in Venice a number of times. I've been in Florence, Rome.
I've
done cycling trips around the country. I've done cooking trips in the country. I've been to the horse race.
I had to work for a living. Monica Defen, thanks for joining us. She's head and chief strategist at Amundi Institute. Right now, let's head down to, I think, Washington, D.C. Let's go to Michael Barr here in New York City. That's even better because he's sitting right across from me.
Thank you very much, Paul, Matt. The push by some House Republicans to launch an impeachment inquiry into President Biden is picking up steam. Bloomberg News confirms Speaker Kevin McCarthy will endorse the probe. More from Bloomberg congressional reporter Billy House.
It's being hinted by Speaker McCarthy, Kevin McCarthy, for some time that he would back a next phase, an impeachment inquiry. But he's going to do that this week in a closed-door meeting with fellow House GOP members to discuss impeachment generally, and for him to tell them that it's an inquiry, an investigation is the next logical step. Let's don't confuse this with actual impeachment. They're drawing a line between inquiry and then whether they proceed to impeachment after that is a whole other ball of wax.
Bloomberg News congressional reporter Billy House. New York area commuters are having a tough time getting around this morning. According to New Jersey Transit, rail service into and out of Penn Station is suspended because of a minor slow-speed derailment. Midtown direct service is being diverted to Hoboken. North Korean leader Kim Jong-un is in Russia to see President Vladimir Putin. U.S. officials say Putin may ask for artillery and other ammunition for his war in Ukraine. A new study suggests the dangers of lead exposure have been gravely underestimated. The World Bank says lead exposure in 2019 may have caused 5.5 million deaths worldwide. Pure Earth President Richard Fuller worked with the study.
When they look at all of the different aspects of cardiovascular disease, lead poisoning is just as big globally as smoking or cholesterol.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg.